operate my business with the help and support of my beautiful partner of 10 years, Jade. I created Zen in the Art of Trading because I got bored of staring at charts all day, waiting for trades, and I wanted to take my trading to the next level. I knew that I required accountability to maintain motivation and inspiration, and without a prop firm or peers to push me, I needed to turn to the online community. Plus, I really miss being creative and going through the creative process, and creating content for the trading community fills that hole for me. I love writing, and I get a kick out of recording videos and helping other traders on their journey, so it's a healthy arrangement for me. I also run the PineScript education website PineScript Mastery, where I teach traders how to code their own scripts. I've always had a weird passion for programming, and it has been a hobby of mine since I was 15 years old. It's funny how things work out. That seemingly benign hobby that I tinkered with for over 15 years, just for fun, has turned into both an extremely successful business and a huge advantage in my own trading. And as for the name of my brand, I'm a passionate practitioner of Zen philosophy, and I believe that trading is an art more than a science, although it's really a combination of both. As Al Weiss once said, chart traders are artists until they mathematically define their patterns, say as part of a system structure, at which time they become scientists. 3 questions I ask myself before publishing my content are, am I confident I know the subject I'm discussing intimately and from personal experience? Am I confident I got the facts straight? And is this content going to create value for others? I'm passionate about being transparent, honest, and humble in the face of the markets. Trading saved my life in the most literal sense, and I have the utmost respect for the craft. That means that this is not a get-rich-quick or parasitic marketing website. The content on my website is intended for committed traders who are extremely serious about mastering the craft of trading. My content is mostly intended for retail traders, since I'm a retail trader, but much of it applies to any form of professional trading. In any case, if you're here for the easy quick fix, you will be disappointed, and so be it. It is my belief that nothing worthwhile comes easy in this life. That's why I'm obsessed with trading psychology and determined to be the best I can possibly be both in trading and in life. I'm in this for the long haul. And so the theme of this website is mostly focused on trading psychology and Forex. But I also have some lessons on how to create your own indicators in PineScript, a bunch of free TradingView indicators, a public Forex trading journal, a YouTube video library, and YouTube channel, as well as a number of other useful tools and resources. Now, I'm not here to tell you that my way is the best way. Far from it. I know there are thousands of ways to be profitable in the markets, and I still have plenty left to learn before I can call myself even close to a master trader. But between 2017 and now, I have gone from consistently struggling trader to consistently profitable trader with the help of some great mentorship. And so I think I have an interesting and ongoing story to tell, which will help those who wish to follow in my footsteps as I followed in those who guided me. I plan to share it all on this podcast and blog for whoever is interested or crazy enough to join me in this endeavor. I want to be completely transparent throughout my trading journey and share what has worked for me and what hasn't. Maybe I can help you avoid some of the mistakes I've made and learn from some of the insights I've had over the past few years. And maybe you can teach me a thing or two from your own experiences, and we can become better traders together. I hope you enjoy your time here and that you find constant value. I'm extremely passionate about trading, and I look forward to sharing my journey, insights, and creations with you and the rest of the trading community. Take care and best of luck with your trading. Sincerely, Matthew. Today's episode is going to focus on understanding exactly and concisely what edge is when it comes to trading. Welcome to the Art of Trading podcast, the #1 podcast focused on trading psychology and performance, at least according to me. My name is Matthew and I'll be your host for today. Let's get started. Every trader has a slightly different interpretation and definition of edge. If you asked 1,000 traders what their edge was, they would all have different answers, even if they trade similar strategies and markets. However, one characteristic of an edge in which all traders will universally agree is that it makes you money over time. Not on a trade-by-trade basis, but over hundreds and even thousands of trades and multiple months and years. It is highly personal and includes psychological components, as bad trading psychology can easily sabotage a trader's edge and cause them to lose money when they should have made money. It does not necessarily have to mean that they win more trades than they lose, although for some traders it does mean that. More importantly, it means that over time, their winners always make up for their losses, and then some. Losing is a part of the game, after all. In trading, there is no way to avoid losses. Or as Mark Douglas once said, "To me, losses are simply the cost of doing business, or the amount of money I need to spend to make myself available for the winning trades." And if you're not sure who Mark Douglas is, you definitely need to pick up a copy of his book, Trading in the Zone. Becoming the casino. So if this is the case, then how does a trader make money? If a trader is always losing, how do they make money? The answer is a matter of simple mathematics. You cannot control whether you will have losses or how much you will win on each trade, but you can absolutely control your risk exposure for those losses and the quality of the setups you choose to take. In other words, you can choose how much you lose on each trade, and you can choose when to trade. This is where a trader's power lies, in risk management. The combination of high probability setups and the elimination of big losses allows for the accumulation of big winners over time. If you trade long enough and you are wise enough to collect detailed statistics about your trading results, then over time you can develop a concise picture of the technical workings of your edge. You can then use this data to determine how to best exploit it or defend it against catastrophic drawdowns by simply adjusting your position sizing or your entire strategy if necessary. Now, for those who don't know what a drawdown is, it simply means the maximum amount of money you lost along the way in order to get to whatever gain you ended up with. So it's the amount of money you lost, usually in a percentage term, from your last new equity high to your most recent new equity high. So if I say I had a 10% annual drawdown, that means that during the year, I lost 10% of my total equity in my trading account at one point. Now, if you trade a strategy with a 45% win rate and a 1 to 2 risk reward ratio, meaning for every dollar you risk, you make $2 when you win, you probably can't risk 2% of your total equity per trade. Because your win rate is so low, you're going to encounter losing streaks. In fact, you probably shouldn't risk more than 1% per trade, given that it will not be particularly unusual to run into 6 or 7 or even 10 losing trades in a row. If you're risking, let's say, 5% per trade with such a strategy, then the winning times will be exhilarating, but the losing times will be devastating and potentially lethal, meaning you are extremely likely to blow your account. Sustainable, consistently profitable trading does not look like that. However, if you had a 58% win rate with a 1 to 2 average risk reward, so the same risk reward profile on average, but a much higher win rate, then maybe you could stomach 2% risk on a trade, perhaps even 3% or more of your total equity on your best setups. Most sensible professional traders would probably never go that high on a single setup, depending on their strategy, of course, and their risk management techniques, and they would never recommend retail traders to. But for the more aggressive traders with genuine edge who are experienced, have confidence and trust their strategy and know it intimately, it's not unusual and in fact can be quite profitable to trade this way. And by that I mean they might adjust their position sizing based on the objective quality of the setup they're taking and its historical win rate. Now, that's not to say that a 58% win rate won't also run into uncomfortably long losing streaks from time to time. In fact, it's happened to me several times in my career, and I typically have around a 50% win rate. But these losing streaks or drawdowns ought to, in theory, occur less often with a higher win percentage. Now, if you want to learn more about the specific math, the mathematical formula behind calculating your minimum win percentage in order to turn a profit, and your average profit expectancy, then there will be a link in the show notes that will link you to a blog article I wrote explaining the math behind Edge. Risk is personal. This means that it all depends on your personal tolerance for drawdown. There is no one size fits all when it comes to edge and risk management in your trading strategies. You will trade my strategy differently to how I do, either better or worse, and vice versa, even with the same rules. This is because of the way you might respond to the characteristics of the strategy. So for example, if it has a high losing rate but high risk reward, so I lose frequently, but when I win big, you might not be able to stomach losing that many trades in a row, and so you might come unstuck. You might start making mistakes. You might start bending the rules a little bit, and suddenly you have ruined your edge and you're headed for a blow up. Some traders are comfortable with a 30% drawdown, while others can't handle even a 10% drawdown. Obviously, this depends on your personality, your psychological profile, and your account balance, how much you're willing to lose in order to make some money. Now, length or duration is also a factor traders should take into consideration. The higher your win rate, generally speaking, the shallower and shorter your drawdowns will be, in theory. Now, the opposite is generally true for a lower win rate. But a strategy that loses often may make more money than a strategy that rarely loses, depending on the average risk reward. This is why risk to reward is equally as important, if not more important, than win rate. And the two cannot be analyzed separately in any meaningful way. They go hand in hand. A higher reward often means a lower win rate. So when developing a strategy, it is important to balance the two. If you're shooting for a 1 to 10 risk to reward, then expect to experience significant strings of losses. But hey, it might be profitable, and if you're comfortable with that, then there is no reason not to experiment with that approach. Well, as the great Ed Seykota once said, the key to long-term survival and prosperity has a lot to do with the money management techniques incorporated into the technical system. So it's not all just about trading setups. Risk management and money management play a key role in the profitability of your strategy. So we've established that risk is personal and edge is personal too. So large or small risk to reward ratio does not matter in and of itself. As long as the strategy makes money over time, then what matters most is that it performs in a way that is compatible with your psychological makeup or personality. If you are the type of person who is impatient and hates being wrong, then trading a 1 to 10 risk-reward strategy is going to be hell for you, even if it makes money, and you aren't likely to trade it to its full potential. You are far better off shooting for more conservative targets and winning more often, but being heftier with your position size because you can afford to be. That is how you make your edge work for you if you don't have the patience or discipline to wait for big winners, or if you find the multiple swing and miss approach too difficult to endure. If you're a busy person who doesn't have time to stalk perfect trades or doesn't care if you lose 10 trades in a row occasionally, so long as the 11th trade pays for them all, then go for it. Give trend following a try, or wider swing trading. Give your trades more time to play out, to hit those bigger rewards, those bigger profit targets. Or develop some kind of position strategy that allows you to hold trades for longer periods of time. The world is your playground, especially the markets. Just remember to manage your risk appropriately and responsibly. So, how do you develop your trading edge? The conclusion from all this is that an edge is not necessarily a reflection of your ability as a trader to be correct in your analysis. Let me repeat that. Edge is not a reflection of your ability to be correct in your trades. Trading is not about being right. If that were the case, all of us would be out of the business pretty quickly. The market is far too complex a beast for any one person, especially a retail trader, no matter how intellectually or game theoretically gifted, to outsmart or outwit every time. Rather than trying to do this impossible task, a technical trader plays the casino instead. They find a set of variables and patterns that, if acted upon in a consistent manner, many times, produces profit over time. Technical traders study a certain market to learn its behavioral characteristics. Then they determine which market conditions are best suited for certain trading opportunities. Then they develop strict rules, objective rules, clear rules, when they should or should not enter or exit a position based on that potential opportunity. Then they test that theory with either historical data or live data, or preferably both. This process is called backtesting or forward testing in the case of testing on live data. With this testing data, the trader can then determine the basic characteristics of the strategy they intend to trade. They can work out its estimated win rate, how often losing streaks might occur, how bad the worst drawdown period was, historically speaking, how long it lasted, what the average risk reward is, and so on. Using this data, they can then develop a portfolio, limiting their trading to only the best performing pairs, stocks, etc. And they can develop a money management plan that suits the strategy, as well as develop a rough idea of what to expect going forward. This helps them determine when the strategy is working or when they might be doing something wrong. If historically your trading strategy had a 50% win rate over the past 10 years and 5,000 trades, and suddenly you start trading it and you've got a 30% win rate over 100 trades or more, there's a very good chance either you're doing something wrong or you overlooked something that is negatively impacting your actual results when you're trading that strategy on live data. For example, commission costs or spread, something like that. Now, obviously, past results are not indicative of future performance. We've all heard that. We've all read the disclaimers. But it is the best we have. And without it, you are literally trading blind. So you might as well backtest. I mean, it's free. If you've got access to historical price action data, then there's no reason why you shouldn't backtest your strategies. And once you've determined that the strategy indeed makes money over a large enough sample size of trades to give you confidence that your good results were not simply the effect of a lucky hot streak, then you can start out small and trade the strategy as consistently as possible. And then as you develop confidence in the strategy and you learn it intimately, and come to trust your own ability to execute it effectively, then you can either increase your position size, if it suits your money management plan to do so, or you can increase your risk capital or account balance. This is the natural progression of a consistently profitable technical trader, as far as I can tell. It is a simple process, really, but it does take time, a lot of time, and the work is often grueling and unrewarding and monotonous. This is why most traders fail. By the time you have confidence in a strategy from the appropriate efforts at testing it, you'll probably be so sick of it that you might not even be enthusiastic about trading it, at least at first. But once the results start to resemble your testing, that is where the fun begins and you start to gain momentum. That's when the rubber meets the road and you start to feel like you've earned the money you're making, because it's not the result of random chance or gut feelings, but rather the result of months of hard work spent developing a meticulous trading plan and then having the courage and the discipline to stick to it. That is a trader's job. That is what we are paid to do. Sit down, be humble, and let the market tell you what you should do next. Trade your edge, not your shirt. I hope you found this episode interesting. If you did, make sure to hit the like button and subscribe based on whatever platform you're listening on. Make sure to sign up to my mailing list over on my blog at theartoftrading.com. And I will be back soon with a new episode. Take care. Best of luck with your trading. Speak soon. The market is ruthless and unforgiving. It punishes even the best traders for making even the smallest mistakes. The only redeeming aspect of this side to the market is that it affects all traders equally. No one gets special treatment. If you screw up, you lose your money, and there's nothing you can do about it. Welcome to the Art of Trading podcast, the #1 podcast focused on trading psychology and performance, at least according to me. My name is Matthew and I'll be your host for today. Let's get started. Unless, of course, you are a major Wall Street institution, in which case you can rely on the Fed or Warren Buffett for bailout money. But most of us don't have that luxury, and we actually need to protect the capital we are managing. That means we need to keep ourselves under control every time we sit in front of our charts. Eliminating big losses. When I first started trading, which is to say, when I first started throwing my money around like an idiot gambler, it didn't take me very long to notice a pattern. Every now and then I would stumble into a big winner or a winning streak and make a lot of money in a week or two. But then in a single trade or a brief losing streak, I'd give it all back and some. I noticed the pattern in my equity curve. Periods where it would climb impressively and then suddenly nosedive into new lows and deeper drawdown. I quickly realized, with the help of various YouTube channels, that I was trading completely opposite to how I should have been. When I really thought about what I was trying to achieve with my trading, I realized that the ultimate goal was to accumulate profits. Not to catch big winners or to be right all the time, but simply to make more money than I lose as often as possible and then keep those profits. It seems so painfully obvious now that I'm a few years into disciplined, consistent trading, but at the time it was a huge epiphany. All I needed to do was eliminate my big losses and reduce my frequent losing streaks, and then allow my winners to accumulate over time. But this turned out to be much, much easier said than done. Accepting loss. It seems counterintuitive, but what you need to do in order to eliminate big losses is learn to accept small losses. Learn to embrace losing trades. Do not fear them. They are merely the cost of doing business as a trader. There's a famous American trader who moved to Australia. He lives here in Australia somewhere, I don't know where. But his name is John Moulton. I definitely encourage you to search his name on YouTube. His surname is Moulton. He's appeared in a few documentaries and other trading content and publications. There's a quote he said during a presentation that really stuck with me. He said, "Losing is extremely important. Winning's easy. Losing is the key to trading." Now, when I lose a trade, most of the time I feel absolutely nothing. At first, I feel a slight tinge of disappointment or sometimes frustration during a losing streak. Alright, maybe now and then I might mumble "F you" at the charts. My girlfriend has come to accept that sometimes I'm going to argue with the markets. But I never become completely unhinged. I never pass the blame. I never revenge trade. I never make stupid decisions following a losing trade. I never lose my cool. I never let a losing trade or streak of losing trades ruin my day. This took many months of practice, and by that I mean many months of practicing losing. I had no shortage of losing trades in my first year, so becoming desensitized to them was actually pretty easy once I began managing my risk properly. Losing 1% of your trading balance on any given trade is disappointing, but losing 10% on a single trade is absolutely devastating. Once I stopped losing that much on trades, I stopped being afraid of losing altogether and was suddenly free to make better trading decisions. Once you thoroughly understand the importance of eliminating big losses from your trading, also known as risk management, developing and following a trading plan makes a lot more sense and quickly becomes your best friend. The main purpose of a trading plan is to take full responsibility for your trading results. No longer are you at the mercy of the markets, but the mercy of your own performance, which is a much better place to be in. The better you get at performing your job as a trader, which is sticking to your plan consistently, the better your results will get over time. Or as the late great Mark Douglas once said, taking anything less than complete responsibility sets up major psychological obstacles that will block your success. And the more experienced you become as a consistently profitable trader, the better your trading plan will become, in turn, making you more money. This is a competitive game of perpetual personal evolution with uncapped reward potential. Only those who are genuinely enthralled by the opportunity will succeed, and anyone with false or weak motives will fail miserably. It is a slow process, but if you take the right approach and stay focused on developing the correct habits through deliberate practice, then you can overcome whatever hurdles you face now and improve as a trader over time. All it takes is your total commitment to becoming a better trader. Plan your trade, trade your plan. After my first few months of trading every day using sensible risk, I developed a new problem. I noticed that the market's behavior tended to make me doubt myself constantly. I'd see a swing trading opportunity that looked great with a huge risk-reward ratio. I'd enter the position, then an hour later, I'd notice that price was slowly moving against me. I'd begin to doubt the trade and come up with a reason to exit it. Then I'd close the position for a small loss, only to wake up the next day and see that it would have won. This was a frequent occurrence that became incredibly frustrating. Over time, I realized that the problem was not the market, but myself. The market was producing infinite opportunities for me to make profitable trading decisions, but I just wasn't yet equipped to make the right decisions. I had no plan. I had no conviction in what I was doing, And why should I? I had no evidence that what I was doing was actually going to work. So when it didn't work, I certainly had no reason to be surprised. Another quote from Mark Douglas. The very reason we are attracted to trading in the first place, the unlimited freedom of creative expression, is the same reason we feel a natural resistance to creating the kind of rules and boundaries that can appropriately guide our behavior. This is around the time I began reading a lot of trading psychology books, such as Trading in the Zone by Mark Douglas, and signed up to a Forex educational course. The first and most helpful course I signed up to was Stephen Hart's EAP program over at thetradingchannel.net, where he teaches you the objective rules of his personal strategies and how to develop your own trading plan. There's no fluff, no hype, no promise of riches, just hours of monotonous, repetitive, hard work, and a lot of spreadsheets. Every week he would email his students examples of trades he was taking so that we could watch over his shoulder and see how he analyzed the markets and applied his strategy in real time. These were not intended as trading signals to copy, but rather he did this in order to make sure that we were executing the strategies we were learning correctly. And before long, I began ignoring the emails altogether because I found that I was already involved in the trade long before he sent them out. This is the power of objective rules-based trading and having a trading plan to attack the markets with. The reality of drawdowns. The last piece of the puzzle for me in terms of my development as a consistently profitable trader was developing the courage and discipline to endure drawdowns. I struggled with this for a while, but Stephen's guidance helped me overcome that fear. Every few weeks he would review each of the trades he had taken and analyze his equity curve, drawdowns and all. What he taught me throughout this process was the importance of consistency. At the end of my first year in the EAP program, he ended up with a 126% return on his capital. But he went through several small but prolonged drawdowns to get there. At one point he was down over 15%, which was his worst drawdown ever at the time since launching the program. And it was very interesting to watch him trade out of it simply by following the plan. It gave me a huge amount of confidence in myself when I finally understood what he was doing. After watching him demonstrate how it was possible to eliminate almost all of the mistakes I was making from my own trading, I thought to myself confidently, I can do this. And I did do it. And I'm continuing to do it, and it gets a little bit easier every day. Like all fears, the only way to overcome your fear of drawdowns is to face them head on. The reality of trading is that most of the time you will not be at new equity highs, but slowly grinding towards them. Accept that reality, prepare for it psychologically and with your position sizing, and before long, drawdowns will become just another routine part of your process that causes no disruption to your performance. Tips for trading discipline. Developing trading discipline is much easier if you know why you are doing it. I'm embarrassed to say in detail exactly how undisciplined I was before I began trading. It's not something I'm proud of, and I had many great excuses for it. But through sheer determination and commitment to my goal, I've become more self-disciplined both in my trading and my personal life than I ever imagined I was capable of being. Learn the theory. The first step I would recommend any new trader take along the path to developing trading discipline is to learn a bit about probability theory in relation to trading. Thoroughly understand the dynamics of win rate versus risk to reward ratio. Knowing this information will help your motivation. If you don't understand your edge or know why trading discipline is important in order to effectively express your edge, then you won't ever find the inspiration to develop your edge. Find mentors. Watch other traders that have demonstrated an ability to trade the market successfully and pay attention to the objective things they do which you can copy. Don't copy their process or their trades blindly, but take notes from their style. I've written an article with tips on how to find your perfect trading mentor, which is worth reading if you're on the market for a new mentor. The link to that will be in the show notes. There are a handful of great mentors out there, some of whom share their insights for free. Mike Bellafiore and Stephen Spencer from SMB Capital is a great example of this, as is Akil Stokes and Jason Greystone from Tier 1 Trading if you're a Forex trader, or my personal trading mentor, Stephen Hart from the Trading Channel. And another trader I used to follow quite regularly was Rainer Teo from Trading with Rainer, who was a trend follower. He trades all kinds of markets, mostly Forex, but also commodities and stocks, stock indexes. And he uses a trend following approach, which is very interesting to study if you're interested in position trading and holding positions for the long term to capture those bigger moves. Another good tip is to read all of the best theory on trading psychology that you can get your hands on. There's some great stuff out there by masters of trading psychology, such as Brett Steenbarger, Mark Douglas, Denise Schull, Ari Kiev, Mike Bellafiore, Jack Schwager, and many others I probably haven't heard of. The Kaizen approach. Discipline is not something you develop as a trader. It is something you must develop as a human being. This takes time. It is a process and it can be quite uncomfortable. The best method I have found for developing consistency and self-discipline is through Kaizen, which is a Japanese philosophy that advocates continuous, incremental improvement. Someday I'll write an article about this concept, but the idea is that you are more likely to stick with small changes and turn them into habits than you are radical changes. So pick small problems with your trading and focus on improving them incrementally. Start with one thing at a time and grade yourself throughout the week on your progress. Once you truly overcome the problem and replace it with a better habit, then and only then should you move on to the next problem and repeat the process. Never underestimate the power of this approach. And also learn to apply it in other areas of your life. If you're undisciplined with your lifestyle and you party whenever you want and sleep in late and neglect other priorities, for example, speaking from personal experience, then your trading will no doubt suffer. You can still have fun and trade, but don't think that if you live an undisciplined life, then you will still be a disciplined trader. It does not work that way. This is perhaps my most favorite part about trading. The work you put in to become a better trader will make you a better person too. Self-awareness. The most fundamental prerequisite to self-discipline is thorough self-awareness. If you're not honest with yourself, if you're either far too hard on yourself or far too easy on yourself, then becoming disciplined will be an impossible challenge. Developing self-discipline is a process. You need to know when to let something slide and when to reprimand yourself, either literally or figuratively. If I miss an A-grade profitable trading opportunity because I was doing something important that I committed to with my friends or family, such as seeing a concert or attending a wedding or a birthday party, I let that go. That's no big deal. Of course, there are many things in life that are far more important than making money, and you can't catch every winning trade. But if I sleep in late and miss a valid setup, or I screw up a trade and lose more money than I should have due to some silly, avoidable mistake, that is unacceptable. That requires attention. That is not something a professional trader lets slide. Sometimes if I break my trading rules or make a blatant error, I walk straight out of my office into the backyard and jump right into my pool with my clothes still on to punish myself. My girlfriend thinks it's pretty weird, but the shock of cold water is usually enough to knock some lasting clarity and sense into me. Of course, this doesn't work in summer, so I have to get creative during the warmer seasons, but you get the idea. It's also wise to do the same thing with rewards. I set desired process-driven milestones in my trading, and when I achieve them, I take my girlfriend out to an expensive restaurant, or my friends, or we go on a short holiday somewhere nice and spoil ourselves to celebrate. But only once I have achieved the milestone. Until then, I work as hard as I can to get there, and I don't let myself get complacent. I certainly don't trade on the beach. The moral of this story is that you know what works best for you. So take advantage of that. This is the best part of being an entrepreneur, and all traders are entrepreneurs. It's fun to get creative with your self-discipline and motivation. Unlike more stable professions, the most beautiful and yet terrifying thing about retail trading in particular is that you are responsible for yourself completely and utterly without any supervision. For an undisciplined person, that's a recipe for disaster. If you do not take self-discipline seriously, then there are no consequences besides your failure as a trader. It's up to you. Deliberate practice. Keep a trading journal and take notes after every major trading decision or mistake you make, especially the decisions that maximized your profit or minimized your loss, or caused you a lot of pain. Reflect on what you are doing regularly, at least weekly, and come up with creative ideas on how to eradicate your negative trading traits from your performance. This could be as simple as leaving sticky notes on your computer screen to read every day, which is something I did for a while. The best way to start if you're slack with discipline, like I was, is to just pick the worst part of your trading and focus on that with a Kaizen approach. For me, when I first started this process, it was risking too much. So I decided on a new rule, that I would only risk 1% of my capital per trade, maximum. It was tough to stick to at first, but it didn't take very long for good risk management to become a habit, as I immediately saw the beneficial effects. The rest slowly began to fall into place after that. It's a lot easier to think clearly when you're not losing massive amounts of money on a regular basis. Adjust the plan. The biggest problem I had once I began managing my risk properly was overtrading. I was so enthusiastic for trading action that I would take any setup that presented itself, no matter how mediocre. This was a slightly harder problem to fix and a problem I still struggle with at times, especially on Mondays when I'm pumped to trade again after the weekend. The key to this problem was to simply develop stricter rules around what a valid setup is, so that I have less subpar trading opportunities to choose from. Anytime I encounter a situation where I'm unsure if I should take the trade or not for whatever reason, I tweak my trading plan's rules to reflect a solution to this problem, and then I retest my strategy until I find a set of rules that produces an edge while reducing the ambiguity in my setups. If you don't trust your trading plan, then it's impossible to trade it consistently. So if you notice that there is something in your plan that is resulting in outcomes you want to avoid, then adjusting the trading plan rather than employing gut instinct or bending the rules is always a better option. You want to be in a position where you know exactly what you should be doing at all times. Then not only do you reduce trading anxiety, but you also make it much easier for yourself to collect the detailed statistics which will be required to improve your edge over time. Obviously, this is a limited process as you cannot reduce all uncertainty in trading, and sometimes circumstances will surprise you. No matter how prepared you are, there will always be things that come up that you weren't expecting. But your goal is not to reduce uncertainty in the market, but rather to reduce the uncertainty in your own mind when presented with a trading opportunity or decision. Or as the great Ed Seykota once said, markets are fundamentally volatile. No way around it. Your problem is not in the math. There is no math to get you out of having to experience uncertainty. In conclusion, the end goal is to be in a place where you can take a trade and not care if it wins or loses, but only that you followed your rules. Once you are in this place, making profits becomes almost effortless, so long as you have good rules to produce an edge, of course. Once you have a trading plan with an edge and clear rules, profit is basically a side effect of just following the plan. A consistently profitable trader does not judge the quality of a trade by whether it won or lost, but by how closely their management of that trade matched their trading plan. Once you get into that place as a trader, making money is merely a side effect of your doing the right thing every day. When you feel good because you followed your plan well, despite being in a drawdown or having a losing day, then you are in exactly the right position to become a consistently profitable trader. I hope you found this episode interesting. If you did, make sure to hit the like button and subscribe based on whatever platform you're listening on. Make sure to sign up to my mailing list over on my blog at theartoftrading.com. And I will be back soon with a new episode. Take care. Best of luck with your trading. Speak soon. Today's episode is all about understanding the importance of consistency in your trading process. If you find this episode interesting, please subscribe and follow the podcast. The links to do that will be in the show notes, and I hope you enjoyed today's episode. Welcome to the Art of Trading podcast, the #1 podcast focused on trading psychology and performance, at least according to me. My name is Matthew, and I'll be your host for today. Let's get started. 4 pillars of trading. Once a trader has discovered a profitable approach to trading that suits their personality, their journey does not end there. In fact, that is where the true trader's journey begins. There are 4 important pillars to trading that every successful trader understands and respects, no matter what their trading style is. The first pillar is risk management. All successful traders know how to manage their risk optimally to suit their style or strategy. Even discretionary traders who do not rely on systematic rules know how to manage their risk properly, or their risk blowing up at any time. The second pillar is edge, which I've already discussed in a previous episode. Links will be in the show notes. Risk management and edge go together, as bad risk management can ruin your edge, and having no edge means your risk management is futile. The third pillar is discipline, or trading psychology, which I've also discussed in a previous episode. Again, the link will be in the show notes. Without discipline and self-awareness, a trader cannot hope to execute their edge properly. And if a trader is not executing their edge properly, they are not going to be successful in the long term. But the final pillar, and the focus of today's episode, is consistency. If you can't measure it, you can't improve it. Even once a trader has thoroughly understood and implemented sound risk management, developed their edge, honed their performance and self-discipline, and found their feet in the markets, they must then focus heavily on consistency of execution. There is a very logical reason for why consistency is such a large part of every successful trader's process. As the title of this section said, if you don't measure something, then you can't possibly hope to improve it. Not only do markets change and evolve over time, making their patterns and behaviors morph, but so do human beings. We must adapt to changing conditions in all areas of life. But how do you know when change is necessary, or if your system is just experiencing a very natural drawdown? This is achieved first through consistency of action, and then through self-analysis, which requires good record keeping, or in other words, a detailed trading journal. Once you have a large enough sample size of live trades, you can then reflect on your results and identify patterns in your trading that lead to undesired, or perhaps more importantly, desired outcomes. Or as Mark Douglas once said, you have to want consistency so much that you would be willing to give up all the other reasons, motivations, or agendas you have for trading that aren't consistent with the process of integrating the beliefs that create consistency. The 4 stages of competence. As we learn and develop a new and complex skill, such as trading, we go through several phases. The first phase is unconscious incompetence. We don't know that we don't know. Then conscious incompetence. We know that we don't know some things. Then conscious competence. We know what we need to do. And then finally, unconscious competence. We do what we need to do without thinking about it. We should all be striving for unconscious competence as traders. A successful trader will always fall within the top 2 categories, either conscious competence or unconscious competence, depending on how many years of experience they have. As we pass through the conscious competence stage, we know what we are doing, but we need to focus in order to do it right. We enter a period of learning which is similar to muscle building. Only through consistent repetition can we form the right habits that will lead to the outcome we desire. Without this deliberate practice, we tend to stay within the conscious incompetence stage. This is usually reflected in our trading as system hopping or general self-sabotage, like entering trades we shouldn't, exiting trades too early, etc. Once we escape this cycle of despair and wrap our minds around what we really need to do in order to be successful, then to graduate from the conscious competence stage, we need to develop serious confidence in what we are doing. And the best way to do that is to measure what you are doing in a scientific manner, collecting as many detailed statistics about your trading process as possible. Or again, as the famous Mark Douglas said, to whatever degree you lack confidence, you will experience fear. The irony is, you will be afraid of random, inconsistent results without realizing that your random, inconsistent approach is creating exactly what you are afraid of. The importance of consistency. As I mentioned several times already, if you want to improve something, then you must quantitatively and qualitatively analyze it first to determine what specifically needs improving. And the only sure way to analyze what you are doing in an effective manner is to make sure that you do the same thing under the same circumstances every time, with as few deviations as possible, so that your data is consistent and you have a framework of known variables to work within. Or in other words, when you see a setup that meets your trading plan's rules, you must execute on it in exactly the same way as you always do. Obviously, not all trading opportunities will be the same, but your process should be. Your stop loss placement should be consistent. For example, if you set it above previous highs for shorts, then use an objective method to determine the price to place it at. For example, some ATR distance from the high. Your exit reasons should also be consistent. For example, if you plan to exit on a trailing stop or by scaling out, then do not close your trade at market on the first sign of trouble or set a limit order at a price you like the look of. The time you decide on these types of key factors is before you begin trading your system with live money. You should have addressed all these kinds of variables before beginning your testing and development process, or at least during it. Once you have a system in place that you have studied and tested and found to be viable, then your only job as a trader is to execute that system in the live markets as closely as possible to how you designed and tested it. If you are a trend-following trader, then there should never be a day that you find yourself in a counter-trend position, unless you've changed your trading plan to allow for such trades. Even if you are a discretionary trader, then you still ought to have rules in place that dictate what opportunities you can and cannot act on, and how you specifically plan to take advantage of them, all in advance. If you do not have these types of rules in place before you trade, then your actions will be inconsistent. And inconsistent actions lead to inconsistent results, and inconsistent results are useless from a statistical analysis perspective. In the computer programming world, this is known as garbage in, garbage out. Even a computer, which is one of the most consistent machines on Earth, will not perform its job well if it is given bad data to act on. How to develop trading consistency. Now that you understand why consistency plays a vital role in trading success, I should probably share a few tips on how to develop it. I am by no means an expert on the subject, and I struggle with it myself like all traders do. But I have made phenomenal progress from how I used to be, and I can share what has worked for me. The first thing you should do is set up a trading journal. Not just a pen and paper one, but a sophisticated spreadsheet that keeps all of your trading statistics. There are a number of services and software out there that can help you do this, such as EdgeWonk, TraderView, and MyFXBook. Links to these will be in the show notes. But to be honest, I find it far more effective to manage my own records manually. It is monotonous, I won't lie, but it also helps drill consistency into your process. Every time I place a trade, I enter the information into a Google spreadsheet. I do this for every single trade I take without fail. There are no exceptions. This actually helped me to cut back on taking impulsive trades that I shouldn't be in when I first began doing it. Because the sheer work of tracking the data for every whimsical trade I took was such a pain in the ass that I began to only take high quality trades that I thought were truly worth the trouble. Some of the information I like to keep track of, and this is by no means an exhaustive list, is the asset I'm trading, the reason for entry, the direction of the trade, the date and time of the trade, my stop loss size, my initial target, my secondary trailing stop target, my risk per position as a percentage of my total capital, notes such as emotional feelings and my thought process at the time, and screenshots of the charts before, during, and after the trade. So anytime I make a trading decision, I try to log the relevant data and or screenshots in my journal spreadsheet. And from this information, I can determine what is working for me and what is not. After several dozen trades, I can see how my live results differ from my testing results. I can analyze my win rate for days of the week, longs and shorts, currency pairs, and even use this data to optimize my portfolios, or in other words, identify and remove underperformers. In conclusion, consistency is a habit that must be formed. It requires repetition and deliberate practice to master. It is not something you just decide to do, and it is not something that can be learned. It is something you must develop over time from personal experience, like discipline and confidence. You know what will work best for you, so I won't give you too many other tips. But some things to think about are your morning routine, breakfast, meditation, exercise, etc. Your morning top-down analysis, how you prepare your charts each day. Your analysis throughout the day if you're a day trader, such as how you read intraday price action. Your post-win routine, what you do after a particularly good trade or a good winning streak. Your post-loss routine, what do you do after a rough week or a prolonged drawdown to take your mind off things and remain focused. The markets you trade. Don't trade markets you haven't planned to. How often you check your charts and at what time of day. This requires consistency, and you should adapt your strategy to suit your schedule. Your pre-bed routine. What do you do with your positions before you go to sleep? Your quiet period routine. What do you do when Wall Street is on holiday and markets are slow? How you draw key levels on your charts. Are you drawing trend lines and support and resistance consistently? What indicators do you use? Don't use indicators you didn't test with your strategy and that you're not familiar with and don't understand intimately. How frequently do you analyze your trading results? Daily, weekly, monthly, quarterly, yearly? I would suggest at least monthly, but if you're a day trader, weekly might be more appropriate. Your education. Even after you become profitable, do you still spend time learning and improving and exploring new ideas? Everything should be consistent in your process. Even your analysis needs to be consistent. You can't define a trend a certain way one week and then define it an entirely different way another week, especially if your trading plan depends on market conditions for entry reasons, as it should. The way you identify what these market conditions are needs to be consistent. What do you need to see before you decide a market is in consolidation? What do you need to see before you decide a market is trending? What do you need to see before you decide a market is breaking out? Once you answer these questions, all you need to do is write them out and do your best to remember them every day. You won't be consistent every day right off the bat, but stick at it for a few months and you'll be surprised at the progress you can make. My trading improved by leaps and bounds once I began taking consistency seriously. I went from being a consistent loser to having 4 consecutive profitable months in a row, and I've never taken consistency for granted since then. Do yourself a favor and stop searching for the perfect system and begin employing what you already know properly first. There is no secret method to trading success. Only you know how to achieve your version of trading success, and it all begins with consistency. Without consistency, you will tread water forever. Be consistent both in your execution and post-execution analysis, and you have a strong chance of making it into the minority of successful traders. Thanks for listening, and I'll see you in the next episode. Take care. Best of luck with your trading. Hi traders, and welcome back to another episode of the Art of Trading podcast. Today's episode is going to address the mystery of technical analysis. Welcome to the Art of Trading podcast, the #1 podcast focused on trading psychology and performance, at least according to me. My name is Matthew and I'll be your host for today. Let's get started. Many new traders and non-traders, and even professional fundamental traders, have the wrong idea of what role technical analysis plays in trading. They believe it's some kind of crystal ball that will reveal hidden secrets about price action and tell them where price is headed next. Some people believe so strongly in this crystal ball idea, they eventually blow up their account from risking too much on trades they are overconfident in. Or they find the whole concept so ridiculous that they believe technical analysis is superstitious hocus pocus not to be taken seriously. Both of these interpretations are very shallow views that completely miss the point. No serious technical trader claims to know for certain where markets are heading just because they drew some lines on their chart. In fact, you should be wary of those who do, because it reveals that they themselves do not understand the purpose of their own tools. What is technical analysis? Technical analysis is the art and science of using visual indicators and pattern identification to determine what price has done, what it is currently doing, and what it might be likely to do next. It provides a way to visually quantify what price is doing in terms of market psychology and positioning. It tells you what traders and algorithms have done in the past, where traders are trapped and fearful, where they are enthusiastic, and where they are shy. It is not, like some people think, a foolproof method of predicting the market. It is much more complicated than that. Technical analysis is a method for determining risk context, detecting repetitive patterns, and timing market entries optimally. But above all else, technical analysis is a tool professional traders use to determine where to put their stop loss. By definition, that implies that professional traders are uncertain where price is headed. So rather than try to outsmart the market with lines and boxes, which is as ridiculous as it sounds, they use technical analysis to determine favorable risk-to-reward setups with at least a half-decent probability of success. They don't need to win on every trade to come out ahead. They know that all they need is at least a decent chance of being correct with an asymmetrical reward to their risk, and they'll do okay. That does not require a crystal ball of any kind. But many scam artists take advantage of people's gullibility in regards to technical trading, which adds to its negative notoriety and reputation. They imply that if you master technical analysis, after paying them a hefty fee to learn their secrets, of course, all your trading dreams will come true and you will never lose a trade again. Unfortunately, when it comes to the markets, there is no foolproof way to determine market direction. But technical analysis can help you to navigate the seas of the markets without losing your bearings, if you know how to employ it appropriately. Managing expectations and risk. As with all complex things in life, markets are inherently chaotic and unpredictable. If they weren't, then all of us would be making a fortune consistently. And yet, in spite of this ever-present uncertainty, some technical traders manage to extract extreme amounts of profit out of the markets on a yearly basis. How do they do it if technical analysis doesn't really tell them where price is going to go? Well, the answer lies in their money management. Professional traders are wrong all the time. In fact, most of them are wrong upwards of 50% of the time. The secret of their ability to extract profits from the markets while being wrong as often as they are right lies in their approach to risk management, not necessarily their abilities of market prediction. Obviously, getting the market direction right is a key ingredient to a winning trade, but it is not correct directional bias alone that will make you a successful trader. Technical analysis gets a bad rap in many places, particularly in the crypto and stock fundamentals community, usually by traders who have been burned too many times going all in on flag patterns and head and shoulders, or by people who have seen too many traders post their technical analysis charts and found them to be wrong more often than they are right, and therefore conclude that drawing lines on your chart is unreliable at best and a completely futile endeavor at worst. But this is the wrong interpretation of the role of technical analysis in trading. Technical analysis, like any tool, is only as effective as the operator and their knowledge of how to operate it properly. And like a weather report, your analysis is only as good as the reality of the present conditions, which are changing constantly. You can make an educated guess at what those market conditions are and what effects they are likely to produce, but it would be crazy to think that you can be certain about your assumptions. Like weather, a lot can change in the markets in a very short period of time, often without warning. As such, it is important to understand that diligent risk control is the key to trading any technical system successfully, no matter how good it is. Or as the great Ed Sekoda once said, the key to long-term survival and prosperity has a lot to do with the money management techniques incorporated into the technical system. Contextualizing risk. As Merritt Black, head of futures trading at S&B Capital, is fond of saying, Context is king. Technical analysis is not just a way to determine market direction. Far more importantly, it is a method for traders to determine risk context in the markets. It helps traders identify high probability trading zones in the market that offer good risk to reward profiles, meaning that if they happen to be right on this trade and price indeed goes where they think it could, then it will be well worth the risk of being wrong. They ignore opportunities in any zone that does not meet this contextual criteria. This is extremely important because as traders, we obviously take a lot of trades. If our winners do not make up for our inevitable losses on balance, then we cannot be profitable. Consider a coin toss that pays 2 to 1 for heads and -1 for tails. Just because it's a great bet doesn't mean that tails can't show up 10 times in a row, or that you should bet all of your money on one coin toss. Even though this is a fantastic wager that guarantees you will make money over time, you still better manage your risk capital according to the odds, or you might not be able to keep tossing the coin long enough to make any money. Accepting uncertainty. The cold hard truth is that no matter how good you are at breaking down a price chart, you are going to be wrong, and often. Even the best and most sophisticated technical analysis setups do not indicate that the trade will win, or even that the market will respect the analysis in the slightest. All experienced traders know that the market is its own beast, and drawing lines and placing indicators over it does not constrain it or force it to comply. If you have any sense as a trader, that idea should amuse you. We've all experienced our best setups fail and watched in confusion as our most confident analysis was completely ignored by price action. When this happens, we typically feel bad. We all like to be correct in our diagnosis, but we need to keep our projections of self-worth out of trading. Being wrong about a market call does not mean you did something wrong. It simply means it didn't pan out this time. The true role of technical analysis is not to determine where the market will go with a degree of certainty, but to simply give you a framework to operate within so that you can plan your trade. Without this framework and structured method of consistent analysis, how do you know when you were wrong on your trading idea? When you lose all your money? When the trade goes against you so much that it begins to hurt? When the unrealized loss hits an arbitrary dollar or point amount? Of course not. This is not how professional traders operate. Instead, they use technical analysis to identify market conditions and context so that they know which setups in their trading plan are most likely to play out successfully, and more importantly, what they need to see before they determine that the setup has failed. Then they calculate how much capital they're willing to risk to see the trade play out, for good or ill, and that's all they need to know in order to make money. Here's a quote from Stephen Cohen, a famous successful trader. Most traders make money only in the 50 to 55% range. That means you're going to be wrong a lot. If that's the case, you better make sure your losses are as small as they can be and that your winners are bigger. The path of least resistance. When you see a talented professional trader perform their analysis, it can often seem in hindsight that they knew exactly what was going to happen. They draw a bunch of lines on their chart and sometimes price does exactly what they say it will. But the truth is they had no idea that price was going to do what they thought it was going to do. All they did was visually define the likely potential scenarios. They used previous experience and their skills at analyzing price action to determine risk context and market positioning, which unveiled the path of least resistance. All they knew was that price was likely to do what their analysis said it would. There was never any guarantee that price would do exactly what they predicted. No matter how certain you might be about a trade, and no matter how many variables might align to form the perfect setup, there is always a chance that an unexpected event might happen to completely invalidate your analysis and cause the market to reverse on you. It only takes one other trader with a massive account balance who disagrees with your thesis to invalidate your analysis, no matter how correct it was, potentially in a matter of minutes. When that happens to a professional trader, rather than hold on to the trade because they have extreme confidence in their analysis, they exit the trade and take the small loss without hesitation because they have extreme confidence in their trading plan. They know that even though their technical analysis failed them this time, that does not mean that their approach doesn't work. It just means that this trade was one of the many losses they are guaranteed to take in their career. So they better keep it small and accept it without a second thought so that they can stay in financial and emotional shape to take advantage of the next trade. And so you clear your charts, rinse and repeat the process again, not knowing whether the next trade will be the start of a losing streak or if it will make up for your previous loss. Such is the life of a trader, where no matter how confident you are in your talents and abilities at market analysis, uncertainty always lurks around each corner, ready and waiting eagerly to disrupt your carefully laid plans. Or as the late, great Jesse Livermore once said, carefully laid plans will miscarry because the unexpected and even the unexpectable will happen. In conclusion, all of this is not to say that developing your technical analysis skills is a pointless endeavor. Quite to the contrary, I believe technical analysis is the most valuable tool in trading. But before you employ technical analysis, you should be certain you understand its limitations and true intended purpose, or else you will run into psychological obstacles. I personally rely almost exclusively on technical analysis for my trading, but I never share my technical analysis with other traders expecting them to be able to, or even want to, use it to trade themselves, like many rookie traders do on TradingView and other social trading platforms. That is a silly assumption to make, since we all have different trading strategies, different risk tolerance, different biases, different time frames, different goals, and different ways of interpreting the market. We each need to take responsibility for our own trading decisions. I couldn't care less what other traders see in the markets, and they shouldn't care about what I see. What matters most is not necessarily your method of interpretation, but the consistency and efficacy of it. If what you do works well enough to make you money while constraining your drawdown over the long term, then that is a good system, even if it is wrong extremely often or someone disagrees with your approach. The point of technical analysis is simply to frame price action in a way that makes sense to you, so that you can trade it in a way that is effective for you. Make sure to check out my blog for the rest of this particular article. At the end of this article, I have a summary with visual examples of a trade that I took before writing this article, where I had analyzed price action in a way that allowed me to take a near perfect trade. Price action barely went against me after my entry and rocketed straight to my take profit. And in that article, I summarize how I felt about that, why I made the decisions I did, and the fact that I had no idea that the market was going to comply with my analysis, and yet I still made money. The link to the article will be in the show notes. I hope you enjoyed this episode. If you did, make sure to share the podcast with other traders you know, and check out my blog and YouTube channel, where there's a wealth of content and resources that can help you in your trading, including tips, suggestions for books and other podcasts, and even lessons on how to code your own scripts to help you analyze the markets. Take care, best of luck with your trading, and I'll speak with you in the next episode. Welcome to the Art of Trading podcast, the #1 podcast focused on trading psychology and performance, at least according to me. My name is Matthew and I'll be your host for today. Let's get started. Hey traders, welcome back to another episode. In today's episode, I'm going to be breaking down my top 10 untold truths about trading. Let's get straight into it. Truth number 1, it's not easy. Perhaps the most enlightening realization I've had about trading is that it is a journey. Like music, painting, writing, athletics, and every other form of human accomplishment, you can improve your craft and skill every day for the rest of your life, but you will never attain ultimate perfection. There will always be something you can do better. As I said in a previous episode, this is a competitive game of perpetual personal evolution with uncapped reward potential. Only those who are genuinely enthralled by the opportunity will succeed, and anyone with false or weak motives will fail miserably. Trading requires determination, commitment, and sacrifice, just like any other professional endeavor. Of course, once you master your niche, trading can become excitingly simple and even fun. But don't expect it to ever be easy. Truth number 2, it's not exciting. Another popular misconception about trading is that it's exciting. Well, I hate to burst your bubble if you thought that, but it couldn't be further from the truth. Of course, there are times when you get excited over your progress or a good week or a particularly good trade, but the reality is those moments are few and far between, and they are usually followed either by a period of boredom or pain. Day traders and scalpers may disagree with me here, but I still suspect that if they are any good at their job, then excitement rarely factors into the equation. As the remarkably cool under pressure free soloist Alex Honnold says, in reference to when he's climbing giant mountains without any protective equipment or ropes, if I get an adrenaline rush, something's gone wrong. Excitement in trading is typically a sign that you're either doing something wrong, like trading too big, or you are focusing too much on your results and not enough on your process. Truth number 3, elite traders are elite spreadsheeters. Another way to word this is that elite traders are elite record keepers. Now, this is probably the most unexpected realization I had when I first began trading. You will be spending most of your time as a trader staring at spreadsheets and statistics. I know, it sucks. But it's what's required for professional performance. If you don't spend more time journaling and testing than you do placing and managing trades, then I can guarantee that you are not performing to your full potential as a trader. During a Joe Rogan podcast interview with retired US Navy SEAL Andy Stumpf, Andy said, "Probably greater than 95% of my career I spent training, and 5% I spent in combat." Our normal planning cycle was 24 to 72 hours, sitting in front of PowerPoint, considering whether or not I should hang myself or blow my brains out. The reason why Andy is still alive to tell his story is because he spent more time planning than executing, and he knew how to adapt when things didn't unfold according to plan. As the adages go, failing to plan is planning to fail, and you can't improve what you don't measure. Truth number 4, you don't need to be right. There is a popular misconception among new traders that you need to be right on a lot of your trades in order to make money. The truth is, most professional and even elite traders do not win nearly as often as you might think. The typical win percentage for some of the market's greatest prodigies is between 20 and 50%, with a very small minority getting anywhere beyond that. Their edge is the result of their ability to quickly admit they are wrong on their trading ideas and take a small loss, not their ability to be correct in their analysis all the time. Obviously, you need to be right sometimes to make a profit, but as I mentioned in the previous episode about the mystery of technical analysis, that alone is not what will make you a successful trader over time. It is the combination of solid risk and money management with a solid strategy that leads to stable growth of your account. Being correct in your analysis is just a bonus. Or as Ed Seykota once said, the key to long-term survival and prosperity has a lot to do with the money management techniques incorporated into the technical system. Truth number 5, you need money to make money. A lot of traders get into trading with a get-rich-quick mentality. This is the single most common cause for traders blowing up and failing at this craft. The average trading strategy cannot handle more than 1 to 3% of your entire account balance at risk on any given trade without opening up the potential for catastrophic drawdowns, which is a euphemism for losing all your money. If you want to be a successful trader over the long term, then your focus needs to be on protecting your capital more so than rapidly expanding it. The average annual return for most professional traders is in the 20 to 40% range, and that is considered outperforming compared to buying and holding index funds and other passive investing methods. My trading mentor, Stephen Hart, has made over 100% on his account for the past 2 years running, and as of recording this, it looks like he's on track to make that 3 in a row. But in my experience, that is wildly unusual, and he has a particularly phenomenal talent for reading markets that few people naturally possess, and it took him over a decade to develop. It also took the endurance of multiple double-digit percentage drawdowns that lasted weeks at times. I think the worst drawdown I saw him go through was close to 30%. So realistically, unless you land a job on Wall Street at a proprietary trading firm, like S&B Capital, for example, which is a famous trading firm, or until you get good enough to manage large amounts of investor money and have the necessary skills to persuade people to give you their money, then you will need multiple sources of income in order to become a full-time trader. Of course, you can absolutely trade part-time without lots of money and still be successful. Just don't expect to pay for your living expenses and your tropical island holidays through trading unless you have 6 figures plus to work with and the skill not to lose it. Truth number 6. Trading is a mind game. Most traders spend their lives searching for and developing the best trading strategy they possibly can, in the quest to make something perfect. The truth is, there is no holy grail system in trading. You will be a far better trader and make more money if you put that time into developing your self-awareness and self-discipline instead of expanding your toolbox. There are thousands of ways to make money out of the markets, and many profitable traders openly give out detailed information about how they trade. I personally reveal most of my strategies on my YouTube channel and in my PineScript courses. I'm not overly protective of my edge because I know it is not going to be other traders copying me that eventually leads to the negation of my edge. When my strategies inevitably stop working someday as markets change, I will be forced to adapt to new strategies. But in the meantime, I am perfectly comfortable showing people what I do and being open about my experiences and my trading approach. The reason is because I know that there is a very slim chance that any large number of people will be able to copy my strategy profitably without adapting it to suit their own personality, preferences, and risk tolerance. It took me years, perhaps a lifetime, of hard work on my own personal psychology before I became mentally equipped to execute my plan consistently and with discipline. And that's not even including the time I spent backtesting, which most people can't even be bothered with. The moment someone copying me runs into 5 losing trades in a row, which has happened to me several times, they will think my strategy sucks and they'll move on to a different strategy. If you want to be successful in trading, then don't just blindly copy me or anyone else. Put in the work on yourself and build the foundation you need to be successful, not just in trading, but in life. Develop extreme self-awareness and mental discipline. Neutralize your ego, be humble, and be open. Do that, and I promise the trading success will come naturally to you over time if you want it badly enough and you put in the work. At least that has been my experience. As the great Bruce Lee once said, be formless, shapeless, like water. If you're interested in learning more about trading psychology, there will be links in the show notes to my top 10 favorite trading psychology books. Truth number 7. You can't trust trading educators, at least not blindly. And I'm speaking from personal experience here. Almost every trading educator you come across on the internet is an internet marketer and product salesman, not a trader. They market their trading business, not their trading success. It is important that you find educators that don't just have good marketing skills so they can pop up on your Instagram feed or on Facebook or YouTube, but find ones that also have a solid public trading record or at least demonstrate some degree of transparency. What are their motivations for teaching you? To make themselves money or to give back to the trading community like their mentors did to them? What is their reputation in the trading community? What do their client testimonials say? I was extremely lucky when I began trading and came across some rock-solid trading educators early on. My main mentor was Stephen Hart, who I have mentioned several times in my podcast episodes and blog posts because he was the final piece of the puzzle for me to break through to profitability. So I will forever appreciate his work and have a great deal of gratitude towards him. But there are a handful of other great educators out there if you know what to look for. Just be wary of their motivations. Look for educators that have a rapport with the community, like Akil Stokes and Jason Greystone from Tier 1 Trading, or Rainer Tio. He's a great YouTuber who teaches a lot about trend following and is very transparent and honest about his results. And especially big trading firms like S&B Capital, which I've mentioned a few times because I greatly respect their work. But there are plenty of other trustworthy, great trading educators out there. Just make sure to do your homework and don't fall for the traps. Or in other words, avoid the Timothy Sykes of the internet. You want a real trader to teach you the ropes, not some 20-year-old jackass who's good at social media marketing and knows how to rent a yacht or a Lamborghini for a good price. If you're in need of a trading mentor and aren't sure how to go about finding one, then my blog article called How to Find a Trading Mentor might help give you some ideas. There'll be a link to that in the show notes. Truth number 8. Signal services and trading bots don't work. This one should go without saying, but it's probably important to mention given its notoriety. If you see an ad for a trading system or a signal service that offers either a set return, such as a set dollar return per day or week, or a set percentage return per year, for example, then don't even think about clicking on it. You will lose your money at best and never achieve financial independence at worst. The markets are not predictable to any degree of consistent certainty. No one can promise you a fixed return. If they could, then why would they be giving it to you over Instagram or YouTube and not to multi-million-dollar investors on Wall Street? In any case, even if you find a signal service or a trading bot that actually works, which I can almost guarantee that you will not, then you are still setting yourself up for disappointment. The key to trading success is having conviction in your own ideas and decisions. If you are following someone else's trading decisions blindly, or you are using someone else's trading tools blindly, then what happens if the person responsible for that system dies, quits, or loses their edge? If you ever find yourself tempted to try a signal service or trading bot, do yourself a favor and invest that money into a reputable trading education site instead. Don't buy a fish. Learn to fish. Some of the best courses cost up to a few $1,000s, but I swear on my reputation as a trader, it will be a significantly better investment over the long term than a signal service or a trading bot. Truth number 9. You don't need financial experience. When I first started trading, I was a financial embarrassment. I was a broke musician still living with my parents and racking up university debt. I readily and openly admit that I began my trading journey as an absolutely clueless idiot. I still have a long way to go, but I have also come an extremely long way since then. Through trading, I have come to know more about finance and economics than I ever dreamed of, and I'm much more confident in myself and my own financial decisions in trading, investing, and in life. So don't think that you need a degree in economics or an understanding of fundamental macro data or anything like that in order to begin as a trader. You don't even need any experience whatsoever. In fact, I would go so far as to say the less experience you have, the better, as you're free to make your own mind up about things. There are a lot of academics that have studied economics that really make for terrible traders and money managers. Unless you want to work for a traditional financial entity like a hedge fund or a bank, don't bother going to university to learn how to trade. All you need to begin as a trader is a computer, internet, a spreadsheet, some money, and a hell of a lot of patience and perseverance. Truth number 10. There are thousands of profitable strategies. As I mentioned earlier, there is no holy grail in trading. It is of the utmost importance that you fully understand this fact. Once you understand that the key to trading is not finding the perfect strategy, but rather finding the perfect strategy for your unique psychological makeup, the journey to success gets much, much easier. It's tempting to think that whatever you are doing right now, maybe there is a better way to do it. And often that's true, which is the hardest part to reconcile as a trader, especially if you're a perfectionist. But that doesn't mean you should drop everything you're doing and try something new right now. A huge part of trading success is consistency, and consistency requires a certain amount of time to play out. If you're changing variables in your strategy too frequently, or worse, hopping strategies altogether, then you will never reach the end of the rainbow. Trading is best approached with a Kaizen philosophy. Small and incremental, but permanent changes. I definitely encourage you to do some research on the Kaizen philosophy. The Kaizen approach avoids radical change, which is not only difficult from a cognitive perspective, as our brains naturally resist radical change and find it anxiety-inducing, but it's also dangerous from a functional standpoint. For example, if you start changing where you put your stop loss without taking the time to determine if that improves or damages your long-term expectancy, then you're never going to make it as a trader. The problem for traders is not that it's hard to find a profitable strategy. That is the easy part. The hard part is finding a strategy that suits your personality, then going through the work to test it so that you can develop the confidence to trade it. Once you do that, most of your trading career is spent improving your mental edge, not your technical edge. Put more energy into developing your mental edge, and you will not only succeed as a trader, you will excel. And finally, as the great Jack Schwager once said, there is no holy grail in trading. Many traders mistakenly believe that there is some single solution to defining market behavior. Not only is there no single solution to the markets, but those solutions that do exist are continually changing. That's it for today's episode. I hope you found that interesting. If you did, make sure to follow the podcast. If you want to learn more about my trading philosophy and approach, you can find more information at my blog at theartoftrading.com. And you can also find a wealth of information and resources over on my YouTube channel. There will be a link in the show notes to that. Take care, best of luck with your trading, and I'll speak to you in the next episode. Goodbye. Welcome to the Art of Trading podcast, the #1 podcast focused on trading psychology and performance, at least according to me. My name is Matthew and I'll be your host for today. Let's get started. Hi traders, welcome back to another episode. In today's episode, we are going to explore my personal top 5 reasons why I think you should backtest. First of all, what is backtesting? Backtesting is the most underutilized secret weapon in trading. It is the process of poring over historical price data and testing your strategy over hundreds or thousands of past trading opportunities in order to collect statistics about your edge. Using a spreadsheet, the trader goes through price action one candle at a time and hunts for occurrences of their setup. Then they objectively track how the strategy would have performed over various market conditions or the past few years of price action. With this data, they can then adjust their strategy to optimize their edge. It's an essential tool that many new traders don't find out about or fully understand the importance of until late into their trading journey. It is not a secret weapon because traders don't want you to know about it. All great trading mentors will tell you about backtesting. It's a secret because most traders don't want to know about it. It's not glamorous, it's not sexy. Many people find it to be boring, monotonous, difficult, and worst of all, pointless. They've been led to believe that backtesting doesn't work or isn't worthwhile, so they don't bother with it, or they do a poor job of it, or they simply don't respect the process. But I disagree with that attitude completely. Without backtesting, I would not be here recording this podcast. I would not be trading every day. I would not have lasted my test of time in the markets. Before we begin, there will be some links in the show notes to my personal backtesting spreadsheet templates if you need them, and there will also be a video lesson or guide explaining the process of backtesting. So if you want help or guidance with the backtesting process, make sure to check those links out. Reason number 1, prove your strategy works. I doubt I would have ever discovered any kind of system that worked without extensively testing it over historical data first. For me, the amount of time it takes to forward test or demo trade strategies is extremely limiting. So when I'm developing a new strategy, I always turn to backtesting first. Through backtesting, I can test multiple strategies across multiple markets within a few weeks. I could even devise an entirely new profitable trading plan within a month or two if I needed to. Backtesting allows you to collect massive amounts of data and information about your strategy with minimal time invested. Of course, it can take dozens of hours to properly backtest a strategy across all the relevant markets you want to trade, but that time is minimal compared to how long it would have taken to collect that data from live trades. Backtesting historical data allows you to witness how your plan would have theoretically performed had you been trading it for the past few years. With this information, you can objectively confirm whether or not what you plan to do in the markets will make you money or lose you money. You should be able to tell within 100 tested trades whether or not the strategy you plan to use is viable, but I personally shoot for at least 200 to 300 trades per market, and sometimes I end up with close to 1,000 or more tested trades per portfolio depending on the time frame I'm trading. If my strategy has a reasonable drawdown and a satisfactory return over that large sample size of trades, then I know with confidence that it is definitely worth my time to attempt executing it on the live markets. As I mentioned in my blog post in a previous podcast episode called What is Trading Edge? The past is never an indication of the future, or at least not a consistently reliable one. But as traders confronting the unknown, it's all we've got. Through testing, we can determine roughly what to expect when our strategy encounters a period of consolidation, or a trending market, a reversing market, or even a flash crash or high volatility period. This can help you to improve your future trading decisions, and as traders, we need to take advantage of every opportunity to enhance and maintain our edge. Without backtesting, you are essentially trading blind. Reason number 2, train your RAS, or reticular activating system, which is a fancy word for your pattern recognition skills. If you follow my blog or you find this particular episode interesting so far, then I assume that you are a price action trader or at least a fan of technical analysis. As technical traders, our main talent is our ability to recognize trading opportunities and danger on our charts. Without that skill, then nothing in the world could help us make money in the markets. And how do you develop skills? Through repetition and practice. Trading and technical analysis are no different. On the one hand, as a trader, a lot of what you do is objectively process-driven, such as risk management and journaling. These things are fairly straightforward and self-explanatory for the most part. All they require is the self-discipline to execute properly, which is different to your ability to recognize opportunities. On the other hand, some of what you do as a trader is subjective. It requires pattern recognition. It requires attention to detail and knowledge of what to look for. It requires discretion and a discerning eye that can tell the difference between a bear flag and a bull flag, or what zones are likely to cause a reaction to price, or where price is more likely to head next. The only way you can develop this talent and skill is through practice. And trading the live markets with live money is not where you want to be getting that practice when you are new to trading. Through backtesting, you can train your reticular activating system to recognize patterns and occurrences of your edge much faster. As Akil Stokes said in a recent podcast, which inspired me to write the blog post that this episode is based on, people ask all the time, how long does it take you to look at a chart and know that you have a trading opportunity or not? And I say, probably about 10 seconds. How do you do it so quick? Well, because I know exactly what I'm looking for. That's a quote from Akil Stokes over the Trading Coach podcast. Make sure to go and check out that podcast if you haven't already. It's great, especially if you're a Forex trader. It's one of the podcasts that inspired me to start my own. Reason number 3, optimize your approach. My favorite part of backtesting is not so much finding a profitable strategy. As I mentioned in the previous episode, 10 Untold Truths About Trading, there are thousands of profitable strategies. Finding a profitable strategy is not the most difficult part of trading. The most difficult part is finding a strategy that works, but is also compatible with your most persistent personality traits. My favorite part about backtesting and trading is finding the balance between profitability and comfort. Through backtesting trading strategies, you can painlessly determine whether or not a strategy is for you, without losing any money in the process. Okay, to be honest, backtesting does kind of suck, so maybe it won't be painless, but it won't cost you any money. For example, if you test a strategy over 200 plus trades and it returned 120%, but at one point the account balance drew down 30%, then you may not want to trade it, or at least you might want to adjust the risk parameters a little bit. But someone else who is more aggressive might love a strategy like that and have no trouble trading it. Or maybe you find a strategy that returns 60% but only had a 5% max drawdown, so you decide it's not unreasonable to double your position size. Or perhaps you find a strategy that works great and you almost feel comfortable trading it, but you notice that it doesn't perform very well during consolidation. This was an issue I had with my strategy that I was using at the time that I wrote this original blog post that I'm reading to you. It wasn't until I devised rules to define consolidation and then stopped taking trades during consolidation periods that the strategy became profitable enough for me to feel comfortable trading it. Before then, my testing results showed promise, but it wasn't good enough. Through backtesting, I identified its flaws and introduced new filters that increased its profit potential and reduced its drawdown. I also identified that my strategy performed terribly on Mondays. After reviewing my testing and journaling results, I realized that I had an abysmal win rate on Mondays. So I stopped trading that strategy on Mondays. Not only did it make me more money by trading less, but I got to have longer weekends, which is always nice. A few years ago, my trading mentor Stephen Hart had to change his forex trading strategy rules. He noticed that he was giving too much space to the market using a 1 ATR stop loss. So he created a simple formula to round his stop loss size down under certain circumstances. For example, if he had a 59 pip stop loss distance, he'd round that down to 50 pips, giving him a slightly better average risk to reward profile. He ended last year with a 152% gain. There'll be a link in the show notes to this particular blog post where I have images and screenshot examples of what I'm talking about here. But in the beginning of 2018, Stephen began the year with a 20% drawdown, which exceeded his trading plan's risk tolerance. According to his original trading plan and testing results and live trading results over the years prior, he determined that he should never exceed a 15% drawdown. If he exceeded that drawdown, something has gone wrong with his strategy and perhaps it is losing its edge. But despite being stressed, he responded calmly by backtesting heavily until he found a new solution to the problem. He didn't just arbitrarily begin moving his stops or adjusting his strategy. He conceived of potential solutions, then he developed rules around those ideas, and then he verified that those rules indeed had a positive impact on his edge through backtesting. That is how professional traders do business. Reason number 4, generate new trading ideas. One of the things that most attracted me to trading in the beginning is the synergy of creativity with systematization. I love combining my right brain creativity to devise trading ideas and strategies, using left brain systematic rules, and then I use a scientific approach to analyze the data and then use creativity to revise the idea using that new feedback and information from the testing process. This is the creative process for nearly all creative endeavors. As a former musician, I spent a lot of time writing songs which required layering. I would start with a bass idea or rhythm or chord progression and then build on it endlessly. And that was the fun part. Not the final product necessarily, but the road to get there. As I mentioned in the previous podcast episode, you don't just simply master trading and then go out and make money. Trading is a journey and you are constantly adapting and evolving. The strategies I currently use to trade were not ideas I had formed clearly in my head without a stimulating catalyst. I discovered the strategies I use today while I was testing other strategies I learned from my trading mentor and other traders out there on the internet. During my testing, I noticed a bunch of repetitive patterns that caught my attention. Some of the strategies I was learning and testing worked, but did not exactly suit my psychology. Other strategies I tested didn't work, but by identifying why they didn't work, I was able to turn that knowledge into an advantage. Backtesting is like a mirror to reality. You might have the best trading idea in the world, but if you backtested over 1,000 trades and it's not profitable, chances are it isn't going to suddenly start working now. Likewise, if you come up with a strange or novel idea that you think probably doesn't work, you may surprise yourself to discover through your backtesting process that it in fact does work. That's happened to me several times throughout my career as a trader. The strategy I currently use to trade is basically a momentum pullback strategy. I buy and sell strong and weak markets into momentum. It's not rocket science, and it's certainly not special. But it is a strategy that I sculpted over time to suit my personality and cater to my strengths and weaknesses, and I'm extremely comfortable with it. But I would have never discovered it if it wasn't for the sandbox of backtesting. With backtesting, you can come up with an idea, any idea, simple or crazy, and then put it through the grinder. Whatever comes out is what you pay attention to. This feedback loop allows you to tweak and perfect your approach until you find a set of filters and rules and conditions and market patterns that not only work and give you an edge in your trading, but also play to your psychological strength. Reason number 5 why you should backtest: to develop sincere confidence. Unless you work for a prop firm and you have a veteran trader with like 10 plus years of consistently profitable trading under their belt, showing you the ropes, telling you their rules, showing you how they trade, then you need to backtest. Any confidence you have in your strategy is naive without backtesting, especially if you learn that strategy from someone on the internet. Until it has stood the test of fire in live markets, you have absolutely no clue how it is going to perform. So if you start trading it and you lose 5, 6, 7 trades in a row, is it any surprise that you feel distress and a lack of confidence? Absolutely not. In fact, you'd be crazy if you didn't. If you haven't backtested your strategy and it suddenly loses 5 trades in a row, then you absolutely should be concerned, because who can say it won't lose another 20 trades in a row? However, for example, if you had backtested the strategy yourself over a large sample size of trades and personally witnessed it endure 10 losing trades in a row and still come out the other end unscathed and profitable, then losing 5 trades in a row wouldn't bother you very much. Even though the experience would be unpleasant, you'd know full well that you have at least 6 more losing trades to take before you should begin to become concerned and maybe start reviewing your strategy to see if you've been making mistakes, or maybe you need to adapt your strategy to new developing market characteristics. Unless you are breaking your rules and not adhering to your trading plan, then you have nothing to worry about. And if you are breaking your rules or failing to follow your plan properly, it will stand out in contrast to your backtesting results, and you'll know what to do. If your backtesting results say you only had a 10% drawdown over a 3-year period, and you suddenly encounter a 20% drawdown in your first 6 months of trading, you want to seriously regroup and find out what is going wrong. Because according to the data, that is not supposed to be happening. But the only way that you would know that it's time to make a radical change to your strategy is if you had backtested it in the first place, or at least traded it for a long time. So don't underestimate the power of backtesting. It's boring and monotonous, and hardly any trader enjoys doing it. In fact, if you enjoy backtesting, I'd argue that maybe there's something wrong with you. But there are elements of every job, no matter how fun or rewarding, that nobody likes. Success in life requires work, and backtesting is work. And if you do the right work the right way, you will find your job as a trader much, much easier. Take care. Best of luck with your trading, and I will speak with you in the next episode. Thanks for listening. If you like this episode, make sure to follow the podcast, and if you want to find out more information about my style of trading or get access to all of my free educational content, head over to theartoftrading.com. Alright, welcome back traders to another episode. In today's episode, I'm going to be discussing my thoughts on how you can find yourself a good trading mentor. Welcome to the Art of Trading podcast, the #1 podcast focused on trading psychology and performance, at least according to me. My name is Matthew and I'll be your host for today. Let's get started. Find a mentor, not just an educator. Learning is a two-way street. It requires feedback, and as retail traders, the only feedback we typically get is from the markets, and it's usually pretty harsh. Having a trading mentor or a trading coach can help you on your way much more efficiently and without as much unnecessary pain. There are many great traders who attribute most or all of their success to having good mentors. And although I personally have a long way to go before I can call myself a great trader, I owe what little success I've had so far entirely to my coaching. I was very fortunate when I first began trading, and I found some extremely good educators and mentors early on. Part of this was luck, but part of it was proactivity on my part too. There's a great quote from Martin Schwartz, Buzzy Schwartz, the author of the great trading book, Pitbull. If you haven't read this book, you need to get a hold of it. It's fantastic. And in the book he says, every top trader had a mentor, someone older, someone wiser, someone who was willing to show them the ropes. Michael Marcus had Ed Secoda. Paul Tudor Jones had Eli Tullis. There'll be a link to this book in the show notes if you're interested. Be proactive. I sought out mentors when I first began Forex trading because I knew that there was a lot of misinformation out there about the business and what it takes to be successful as a trader. The very first thing I did when I decided I wanted to begin trading was keep my ear out for anyone in my social circle who had either traded or knew someone who traded. The first person to mention a trader to me happened to be my girlfriend. This was back in 2017, I believe, and at the time she was working for a content management company that helped people build websites, the content, the back end, all of that stuff. And she told me that her boss traded Forex, as did his brother, and they were both very successful at it. So I immediately jumped on the opportunity and asked her if she could arrange a meeting for me with him. I was obviously nervous, and it was totally out of my character to go and ask a stranger, especially my girlfriend's boss, someone who was significantly more successful than me at the time. And I was kind of embarrassed to be asking him to meet with me, to be honest, but I knew it was a great opportunity, and I put my self-consciousness and my insecurities aside, and I sent him an email, and he got back to me. Even though I was nervous, I knew it was important that I begin on the right foot, so I took a leap of faith, and it paid off. This millionaire businessman I'd never met graciously agreed to meet me to talk about whatever I wanted to ask on his lunch break. Over lunch, I asked him every stupid question I could think of about Forex trading, and I took notes. He was extremely gracious and patient, as I was clueless at the time, and yet that didn't seem to bother him at all. And when I say clueless, I mean I was shockingly clueless. Some of my questions were downright embarrassing in hindsight, but at the time I needed to know this information. Anyway, it turned out that Peter, is his name, was an algo trader, and he was using Python scripts to trade his automated strategies while he operated his web development business during the day with his business partners and staff. Pharaoh, go away. I'm recording a podcast, mate. Sorry about that. My cat is wailing because my girlfriend's left, and whenever he's home alone with me, he thinks that everything's gone to hell and he'll never be fed again. Algorithmic trading was obviously way out of my depth at the time, but his advice was extremely helpful. He told me that he wasn't going to give me his strategy's rules. I didn't ask for them, and I didn't intend to, but he made it clear that giving me his rules wasn't going to help me. Instead, what he did was far more valuable. He told me what I needed to focus on in order to achieve long-term success in trading. He explained the importance of risk management and trading psychology. He told me which brokers were most reputable and what resources I should use to educate myself. He gave me his email and said I could contact him whenever I wanted. Unfortunately, I've lost his email since then. If I had it, I would send him an email these days to let him know that I did find success as a trader, and I'm extremely grateful for his help and guidance early on. Anyway, later he told my girlfriend that he was actually impressed that I took the initiative to contact him before starting my trading journey. Apparently, my nervousness was unnecessary. Not only was he willing to help me, but he went out of his way for me. He even refused to let me buy his lunch. And if I remember correctly, I think he bought my lunch, which is completely backwards, but that's the kind of character he was. The point of this story is that you should never be afraid to reach out to people who you think could offer you good guidance, especially if you are genuine and respectful of their time. Anyway, I never actually needed to contact him again because I soon found an online trading mentor who goes by the name of Stephen Hart from thetradingchannel.net. And his style really fit my technical trading style, much better than any of the other trading mentors I'd come across, or Peter for that matter, since he was an algorithmic trader and I wanted to be a discretionary or manual click trader. And Stephen really propelled my journey forward. But in saying that, I am extremely grateful for Peter's generous early guidance, and I believe his advice prevented me from starting out much worse than I did. And to be honest, I still started out pretty poorly, but I at least had an image in my head, a goal, a clear vision of what successful trading looked like. And it was just a matter of doing the work to get myself there. Anyway, as I said, the point of this entire story is to say, if you are serious about trading and you discover that someone you know is also involved with trading, then don't hesitate to contact them. Let them know that you are passionate about trading and that you aren't going to waste their time. They might say no, but if they do, that probably means they haven't got much to teach you, or they aren't a suitable mentor for your level of development. But when they say yes, pick their brain. Don't be shy. Great traders love to talk shop when they meet someone who genuinely listens and is interested. Be respectful because their time is more valuable than you probably realize. But take advantage of that moment whenever you meet a successful trader who is willing to show you the ropes, and ask them what works for them. They won't mind. Online mentorship. The only other avenue you have if you can't find a successful trader you can meet with in person is online mentorship. This is the easiest and most popular form of trading mentorship, but it is rife with danger. There are many trading gurus, quote unquote, out there who claim to be selling mentorship, but really they're selling a product or a pipe dream. True trading mentors will not be pushy. They won't care if you buy from them or not. They won't overhype their services. Quite simply, they don't care. Their trading mentorship business is usually a side project that they do because they're bored during the day waiting for trades, and or they're passionate about trading and they get a kick out of teaching traders. I know that's part of my motivation for doing what I do. Every email I get saying that I significantly help someone on their journey makes me feel good about giving back to the trading community, as trading can be a very self-centered business where all you're thinking about is yourself, your own money, your own results. It's nice to give back sometimes. A professional Forex trading coach I follow named Jason Greystone from Tier 1 Trading covered this topic in an excellent video that I'd watched while writing the blog post I'm reading here. There'll be a link to this video in the show notes. Now, I've never worked personally with Jason, but I have taken his courses and he is the real deal. And he has a lot of valuable content to share for free with the trading community on his social media channels. So make sure to go and check his stuff out. Same with his business partner and fellow trading coach, Akil Stokes. Anyway, in this video, Jason breaks down good and bad educators into two groups. One group that is trying to sell you a product and keep you dependent on them, the bad group, and one group that is trying to sell you personal independence through education, the good group. Trading education is an extremely important part of your journey as a trader. Without it, you are doomed. But the problem is, there is no one-size-fits-all solution to trading or trading education, which means that there is a hell of a lot of misinformation out there, ranging from downright lies and fraud to an overwhelming amount of good information, and thus general confusion about what works or what might work for you. A trading coach will help you resolve this. If you are serious about trading and you find a trading style that you like, but you haven't quite developed the necessary habits and techniques to execute on that style profitably yet, then a mentor will be the final piece of the puzzle for you. I can say with certainty that if you put in the work and you find a good mentor that you get along with and you can trust and who has a proven track record, then you will find success as a trader. It is only a matter of time. A good trading educator will not just be an educator or a coach, but also a mentor and a guide. They will answer your questions personally. They will give you feedback and suggestions to improve your craft. And at times, if it's necessary, they may even be harsh in their feedback. If you take their advice seriously, they will take you seriously. There will be no question that you are on the right path. That is how you'll know if you've found a good trading educator. So then, how do you tell what a bad educator looks like? They can often be hard to recognize until it's too late and you've already paid them money. Like many others, I was caught out by this in the beginning. Well, here is the cheat sheet for identifying bad trading educators. How to identify bad trading educators. Here's a quote from Jason Greystone. If they're putting you off trading, I can guarantee you they're a pretty good educator. What is their philosophy? What drives them? What motivates them to do what they do as a trading educator? If they're all about the money and they always feature their Lambos and Rolexes and luxury hotel rooms and expensive clothes in their content, then beware. A real trader doesn't have time for that nonsense. A real trader is humble and hardworking like any other serious professional. They are not obnoxious. They are not loud and stupid and flashy. Most of them dress like they're on their day off. They've got nothing to prove. Traders are financially enlightened. They don't live like high-rolling gamblers or poker stars. They don't buy expensive liabilities like Lamborghinis and mansions, at least not until they can buy them without taking on unnecessary amounts of debt. And they don't spend most of their time on beaches or in five-star hotels sipping cocktails and eating expensive food. Certainly they spend some of their time doing that. I am starting to do that a little bit when I can. but not most of their time if they're a serious professional, or they're retired, maybe. Internet marketers do that crap, and it's all an advertisement and an act. A real trader lives a normal life like anyone else, grinding out their daily work. The only difference is they love their work, they have a lot more free time, and a much better understanding of genuine wealth. What is their product? Some trading educators have products that are genuinely helpful. Of course, all great trading educators will have a high-quality trading course complete with videos and examples and tutorials and all that fun stuff. But as part of their service, they might also sell products, such as complex spreadsheets used for backtesting and journaling your trading, which is extremely valuable as no one in their right mind enjoys creating complex spreadsheets. Or they might sell an indicator or software tool that makes your life easier as a trader, like automated technical analysis tools such as an advanced pattern recognition tool or a dynamic structure indicator as Tier 1 trading offer. These are quite useful tools that are typically reasonably priced or included in your course membership. These are the kind of things you should expect from an educator. However, if the trading educator has trading robots for sale like MetaTrader expert advisors that auto trade, or a signal service, or any other too good to be true but expensively priced product, really think hard before you buy from them. Put yourself in the shoes of the seller. Do you think they have your best interests at heart, or do they just want your money? Unfortunately, in the real world, most of them just want your money. So don't give it to them. Give it to someone who deserves it, who has earned the trading community's trust, and who has genuine quality to offer. Pay attention to client testimonials. They are your best way to determine if someone is worth your time and money. What are their tactics? Watch out for people operating out of a scarcity mindset. If they make you feel pressured to buy, then move on to somewhere else. You want a trading coach, not a pushy salesman. If they are promising you a set amount of return over a set period of time, such as earn $100 a day, or 20% a month, or some fixed figure like that, then you're in the wrong place. There is no such thing as a free lunch in trading. You have to work hard every step of the way and fight for every point of profit. If they are selling a dream, telling you it's easy and that you can make a lot of money with minimal effort or time, then they are lying to you. They are cashing in on your ignorance and impatience. They don't care about you or your trading success. They just want you to buy their books or their buggy software or their rubbish expert advisors. Check their affiliations. If they're affiliated with a broker and pushing you to sign up to one, then that's a red flag. You can be almost certain that they make more money from broker referral commissions than from their actual trading. And last but not least, are they transparent? Any trading coach or mentor worth your attention will be fully transparent about both trading in general and their own personal trading. They won't lie to you. They'll tell you how hard trading is, and they will be open about their own trading struggles and obstacles and drawdowns, and will frequently share their insights on how they overcame them. They will often share their trading records or trading journal with you and be open about their losing trades. In fact, the best ones will focus more on their losing trades than on their winning trades. Once you have a year or two's worth of experience in trading, you should be able to tell when a trading educator is telling the truth. The best educators will allow you to watch over their shoulder as they trade. They won't hide anything from you. The biggest value factor of a trading educator, I think, is, in fact, watching them endure drawdowns or losing streaks. Watching a real trader endure a real drawdown or a brutal losing streak and then come out the other side victorious is the real value of a mentor and trading educator or trading guide. That's what you are paying for. You're not paying them to be impressed. You're not paying them for them to show you how good they are. You're paying them to help you. And the best traders know that the only way to do that is by leading through example. As I mentioned in a previous episode and blog post titled 10 Untold Truths About Trading, trading is a mind game above all else. A trading coach and mentor will be the light at the end of the tunnel when you think you can't make it. They will be there to lift you up when you inevitably fall down or stumble. They will share the journey with you. Mike Bellafiore from S&B Capital sums it up best. A mentor can lead you to discover the talent inside of you. Sometimes you just need to be told that you can do it. I hope you enjoyed today's episode. If you did, make sure to follow the podcast on whatever platform you're listening on, share it with your trading friends, and tune in for the next episode. Head to theartoftrading.com for more trading education, tools, indicators, scripts, courses on how to make your own scripts in PineScript for TradingView, and my socials, all that fun stuff. I get quite bored as a trader. I'm a swing trader. I trade the 4-hour time frame. Today I have no trading setups setting up, and so I'll be making content all day. So I often put out new content regularly. Go to theartoftrading.com, sign up to our mailing list to be informed of any major updates, and I will see you or speak to you in the next episode. Take care, and best of luck with your trading. Goodbye. No. 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 Seriously? Hello my friends and fellow traders, welcome back to another episode. In this episode, I'm going to be exploring the subject of win rate in your trading. This is a performance metric of your trading that most traders, especially beginner traders, misunderstand the importance of. Many traders think that their win rate, the amount of trades that they win, is the most important metric of their trading. In today's episode, I'm going to be destroying that idea and explaining in detail why your win rate is not the most important metric of your trading and may in fact be one of the least important. Welcome to the Art of Trading podcast, the #1 podcast focused on trading psychology and performance, at least according to me. My name is Matthew and I'll be your host for today. Let's get started. Question number 1. What should your win rate be? Most Forex traders and traders in general think that their win percentage is the most important statistic of their trading. The relieving truth is that this is not the case. Trading is one of the most counterintuitive skills you will ever learn. Often what is right seems wrong. The idea that you can lose more trades than you win and still make money feels wrong. Humans are used to absolutes. We are not good at dealing with probabilities and vagueness. We like black and white scenarios. We like to think that winning equals good and losing equals bad. But in trading, this couldn't be further from the truth, and is in fact a dangerous attitude to have. Now, before I continue, I want to quickly mention that I created a video lesson on this subject over on my YouTube channel. If you prefer to learn this stuff in an audio-visual manner, then you can find the link to that video in the description or show notes. The answer to that first question of what your win rate should be is it doesn't really matter. You should not build your trading strategy around your win percentage. Instead, you need to build it around your average risk to reward profile or ratio. Using a simple mathematical formula, you can easily calculate exactly what your win percentage needs to be in order to break even. This is the only win rate statistic that truly matters. If you stay above this hit rate, you will be making money. It's that simple. How much money depends entirely on how good your strategy is for the current market conditions, but whatever you're making, you can sleep knowing that you are on the right side of the fence and you are going to be a profitable trader. The formula to calculate your minimum win percentage is this. Your minimum win percentage is your risk divided by your risk plus your reward. And if you multiply that number by 100, you'll get a percentage. And your risk and reward should be based on your average risk reward over a decently large sample size of trades. You will need at least 100 trades, I would recommend, in order to get a relatively accurate number here. So for example, if you have a 2-to-1 average reward to risk ratio, meaning for every dollar you risk and lose, you make $2 when you win, then you will only need to be winning 33% of your trades over the long term in order to break even. If you exceed that win rate, you will be making money. The formula for getting that number, 33%, is 1 divided by 1 plus 2 times 100. That gives you 33%. That is your minimum win rate. If you exceed that win rate, using an average risk-reward profile of 2-to-1, then you will be making money. So if you're winning 35%, 40% of your trades with a 2-to-1 risk-reward profile, you'll be profitable. In other words, you could be losing 60% of your trades and still be profitable. For a 3-to-1 average reward to risk ratio, you only need to win 25% of the time to not lose money. Now, all of this is excluding commission costs, spread, slippage, and all of the hidden risks and costs of trading. But it's a great place to start if you're not sure what profitable trading should look like. All of this means that the higher your average reward is, then the lower your winning percentage needs to be in order to make money. Sounds good, right? It is. But the catch is, the more reward you shoot for, the less likely you are to get it. Over on my blog, again, there'll be a link to that in the description or show notes, I include a visual chart that was provided by Nick Raj from The Chartist, a highly reputable Australian veteran stock market trader. And in this chart, he plots what your minimum win rate needs to be in order to be profitable. The line is charted against your win-loss ratio or risk-reward ratio. It's a very useful visual example of what this concept looks like. So if you prefer to learn visually, you might want to jump over when you get time and check out some of the visual examples I've included in this particular blog article that I'm reading here. So in other words, it's not as simple as just shooting for a higher reward on each trade. When you are developing your trading strategies, you must balance your risk-reward profile with your win percentage until you find a combination that you feel comfortable with. The psychology of losing. Your win percentage is almost meaningless on its own in terms of making you money. Almost meaningless. This theoretically means that if you find a strategy with a huge reward to risk ratio that only wins 10% of the time, but still makes you money, then technically that is a feasible way to trade. And there are stories of professional traders who trade this way, especially trend following traders, where they only win 10 to 20% of their trades, but still turn a very nice profit over the long term. But even though this type of trading would make you money, the chances of you having the discipline to stick to such a strategy is slim. Unless you're automating this strategy or you have a very strong discipline to stick to a rules-based systematic approach to trading, it's going to be really difficult for you to stomach losing a significant portion of your trades, even if it still means you make money. The problem here is our ancient psychological structures inherent in our brains. A computer algorithm could trade a strategy like this, no problem. It can take 9 losses in a row and not feel any trepidation whatsoever about taking the 10th trade. Human beings, on the other hand, are an entirely different story. What do rats and traders have in common? During a lecture I watched before writing this article, given by Canadian psychologist Dr. Jordan Peterson, I've been following his work long before he became a famous controversial figure in psychology, but during one of his university lectures that he uploaded online, he mentioned a very interesting fact about game ethics in rats. It turns out that rats, which share 97% of genetic and primitive behavioral characteristics with humans, have a built-in maximum loss tolerance. Here's a quote from that lecture by Jordan Peterson, commenting on Dr. Jacques Panksepp's research. I probably butchered that pronunciation. In fact, I almost certainly did, but this quote is very interesting. Jordan says,
and so let's say you're a rat, okay? Because like I said, a rat's a good model for a person. Let's say you're a little rat, a juvenile male, and you want to play, because you want to play. And you'll work to play, and that's how we know you want to play if we're experimental psychologists, because you'll button push like mad to get access to an arena where you can wrestle with another little rat. And so rats wrestle just like human beings, and they even pin each other just like human beings, and they love that. And so if you put little rat A in with little rat B, and little rat B is 10% bigger, little rat B can stomp the hell out of little rat A all the time. So then they play and they wrestle, and little rat A loses. And then next time, they both know that little rat A is the inviter, because he's subordinate. So he's the one who has to go up to the big rat and go, you ready? And the big rat then will wrestle. However, if you repeatedly pair them, and the big rat doesn't let the little rat win, at least 30% of the time, the little rat won't invite him to play anymore. And that was Jaak Panksepp who figured that out. And that is mind-boggling. Because it tells you, like, there's an ethical basis for play that's so deep that the damn rats, and they're rats, right? Not known for their sense of fair play. The big rat has to let the little rat win 30% of the time, or the little rat will not play anymore.
There'll be a link to that lecture in the show notes if you're interested. It's actually very, very interesting and surprisingly relevant to trading, even though it's on pure psychology. Jordan Peterson goes on to summarize what this basically means. First of all, everything in life is a game. Some games are more serious than others, but they are games nonetheless. Trading is a game. It's a high-stakes strategic game that requires a particular kind of skill and dedication to be successful at it. But just like rats, human beings have a maximum pain tolerance for losing when it comes to playing games. If we engage in a competitive activity with someone or something that has superior talent to us, for example, the markets, and we don't win at least some of the time, we tend to lose confidence in ourselves. Human beings enjoy a challenge. In fact, we thrive on challenge. Challenge imbues our lives with meaning. Without anything to challenge us to improve and get better, we stagnate, we atrophy, we lose interest. However, if the challenge is literally impossible, and no matter how hard we try, we keep experiencing loss, then that is arguably worse than no challenge at all. It demoralizes us. It discourages us from committing to the game. It makes it difficult for us to develop confidence in our ability to perform. Of course, there are exceptions to this. For everyone, their personal loss tolerance will be different. There are traders out there with abysmal win rates that still kill it in the markets. I wrote a blog article on one such trader recently, but be honest with yourself. There's a big difference between backtesting and trading live. A strategy with a low win rate that makes a lot of money might look fantastic on paper, but if you are losing more often than you can psychologically endure, then you are going to make mistakes. You are going to lack conviction in your trades, and you are going to sabotage yourself. Speaking from personal experience. Winning is subjective. Over time, you will discover what your personal loss tolerance is. And then once you have that number, you will know which strategies are more likely to work for you and which aren't. With this information, you can craft your perfect trading plan. For example, I was very attracted to trend following when I first began trading. It didn't bother me to know that big winners were rare and that I would be taking a lot of losses. I always thought that I could handle losing lots of trades if it meant I still made money. And to a large degree, this is still true. I have no ego when it comes to trading. I have nothing to prove to anyone. I am just trying to make money from the markets in any way possible. But I still feel much more comfortable with my trading if I am winning at least 45% of the time. Whenever I get below that ratio, doubts begin to creep in. I begin to wonder how long the losing streak will go on for, and if I ought to be doing anything different to prevent it from getting worse. I suspect that I'm not the only one who feels this way during rough times. Having a low win rate can work, but it opens you up to a host of potential psychological obstacles and traps. So keep that in mind when you are designing your strategies. Forex trading coach Akil Stokes from Tier 1 Trading discussed this topic in depth in his 28th podcast episode. If you're interested in learning more about this subject from a highly reputable professional trader, then I highly recommend you give this episode a listen. There'll be a link in the show notes. So don't just take my word for this. Even one of the most successful trading coaches in the Forex industry shares my opinion on win rate. Simple math. In the process of researching reference material for this article, I stumbled across this interesting post by Singaporean trader Rainer Teo. I'll link to his post in the show notes as well. Rainer is a well-known trend follower and trading educator with a great reputation among the trading community. I've watched hundreds of his YouTube videos and I can personally vouch for his authenticity and credibility. In this post that I mentioned, he breaks down the basics of risk-reward. He also lays out the simple algebraic formula for calculating your expected average return based on your past trades and your win percentage. I know, math sucks. Or maybe it doesn't. If you're someone who's great at math and enjoys doing it, then good for you. You are definitely going to excel as a trader, so long as you can keep your psychology in check. Personally, I'm not great at math, and it is a handicap. I appreciate and respect math, but I suck at it. I have the equivalent of math dyslexia. But luckily for traders like me, this math is very simple. The formula for calculating your expectancy is this. Your expectancy equals 1 plus your average win divided by your average loss multiplied by your win rate minus 1. That will give you a percentage. I'll leave these formulas in the show notes as well, but they are also written out on my blog post if you want to go and write them down yourself. Now, for traders who are hearing this, who are more like myself and need a little bit more help to understand this concept, I'll lay out an example of how to use this math to calculate my own personal minimum win percentage and expectancy. I'm going to convert Rayner's calculations from dollar amounts into percentage amounts, as I believe that is a better way to analyze your trading results. Calculating your expectancy and your minimum win percentage. At the time that I wrote this blog post, the year wasn't going very well for me. The year before was fantastic. After a few years of trading actively, I finally broke through my period of consistent losing and had 4 profitable months in a row for the first time ever. It was exhilarating, and it was what inspired me to create my website, my blog, my podcast, my YouTube channel, and all of the courses that I've created over the years since then. At the time this happened, I knew that I was very close to attaining consistent profitability, and I wanted to share that journey with the trading community on my blog. Fast forward to April 2019. I am now at break even for the year and in a 6% drawdown after 3 months of trading and struggling to get to new equity highs. Now I'm going to read the rest of this article from the first person as though this was happening currently, but this was a few years ago and I did manage to trade my way out of this hole. Anyway, it has been rough, but I've learned a lot about my strategy and myself. Along the way, I've been collecting as much statistical data about my trading as I can manage, so that I can identify areas in which I need to improve. Using this information, I can plug my numbers into these mathematical formulas to calculate my personal danger zone, meaning my minimum win rate, and my theoretical expectancy over the coming trades. If my strategy's win rate falls below this danger zone, then I'm going to start losing money. If it stays above it, I will make money. And the expectancy formula will tell me how much I can expect to make or lose on average over the long term. How to calculate your win percentage. I've taken 58 trades this year since February when I began my public trading journal. 22 trades won, 31 lost, 5 broke even. That means 9.43% of my trades were break-even trades, but we'll ignore those for the purposes of this example. This gives me a total of 53 trades that either won or lost and a win rate on those trades of 41.51%. To calculate your win rate, it's very simple. It's just your total winners divided by your total taken trades. Multiply that by 100 and you'll get your win percentage. Now, how to calculate your average gain or loss. My average winner has been 1.45%. My average loser has been 1.03%. I calculated my average winner by adding up all of my winners as a percentage of my total capital. So I'm ignoring the dollar figures here. I'm just focusing on the percentages. And then I divide the result by the total quantity of winning trades. And then I did the same for losing trades. So if you add up all of your winning trades as a percentage of your account balance and then divide that number by how many trades won, you'll get your average win percentage. And same for your losing trades. Add up all of your losing trade percentage amounts and divide that number by your total losing trades. That will give you your average risk to reward profile. So how much you risk per trade and lose on average versus how much you win per trade on average. Then, how to calculate your expectancy. Now that I know my win rate, my average gain, and my average loss, I can calculate my average long-term expectancy. This is how much I can expect to make on average per winning trade over the long term. Obviously, some trades will be larger, some will be smaller, but the average gives you an idea of what is the mean. We've all heard of mean reversion in markets, and our trading is no different. Calculating our mean, aka our average, win and loss, will give us an idea of when we are underperforming or overperforming our strategy. The formula for calculating my expectancy based on my numbers is this: 1 plus my average win divided by my average loss, multiplied by my win rate, and then I subtract 1 from that number. So that gives me 1 plus 1.45 divided by 1.03 multiplied by 0.4151, or my win percentage, minus 1. That math gives me an expectancy of negative 0.00054%. Now what does this mean? It means I'm toying with my danger zone. My win rate is currently too low for my average win size. For every 1% that I risk on a trade, I am losing minus 0.00054%, which means I'm basically breaking even at this rate, which is exactly what my results show. How to calculate your danger zone. Now that I know I am trading within my danger zone, how do I work out exactly what win percentage that danger zone is? Well, using the formula that I mentioned at the beginning of this episode, I can plug my numbers in and find out. My minimum win rate is my average risk divided by my average risk plus my average reward times 100. So for me, at the time of writing this blog post, those numbers were 1.03 divided by 1.03 plus 1.45 times 100. And that equation gives me my minimum win rate to break even, which was 41.53%. This means that based on my average risk of 1.03% and my average reward of 1.45%, I need to win 41.53% of the time in order to not lose money. And my win rate as of writing this post was 41.51%, which means I have a slightly negative expectancy, which means I need to lift my game. I am not expressing my edge effectively. I should have a win rate much closer to 50% according to my backtesting results. But I'm a developing trader with a lot still left to learn, so it's not particularly surprising that I'm underperforming right now. I've also only taken 58 trades in this sample size. I really need to have taken upwards of 100 trades before I can get a definitive reading on my statistics. During backtesting, my strategy endured drawdowns that lasted up to 3 months. But over hundreds of trades, it had a strong positive expectancy. So as long as I do my best to stick to my plan, then I have no reason to panic yet. I just have to keep on keeping on and putting in the work, and then reassess when I hit 100 trades. Spoiler alert, I did do that over the years since then. I recovered my drawdown, and now my trading is going much better. And I did that through the help of these mathematical formulas, which gave me confidence and realistic goals to aim for. Now, over on the blog post, I have a section full of theoretical math examples to demonstrate the different ways you can apply these formulas using realistic average win rates, average loss rates, and average winning rates. Just for those of you who are like me and struggle with math, if you need some more visual examples of how to apply these formulas to your own trading in practice using your real trade metrics and data, make sure to check out the blog post. There's a link in the show notes and plenty of theoretical examples over there. So in conclusion, the point of this episode is to demonstrate that focusing on your win percentage alone is pointless. Unless you are balancing your average gain and your average loss against your win rate, then you are focusing on the wrong metric. Increasing your win rate won't help if it's not the problem. Determining what is the problem is much easier if you know your danger zone and your average expectancy. If your backtesting results show a positive expectancy, but your live trading shows a negative expectancy, then you know that there's a high chance that you are not executing your plan properly and consistently. For example, if you're winning a lot but not making any money, then that means you are not allowing your winners to run and you are suffocating your profitability by cutting your winning trades too early. Trying to win even more often won't help that type of problem. In fact, I can guarantee it will make things worse by adding more pressure on yourself in the wrong area of your trading. And if your live trading results are going through a drawdown, but your overall expectancy is positive based on the numbers that we've gone over here, and you are still striking a win rate that is above your danger zone, then you have nothing to worry about. You're just going through a normal, natural drawdown or losing streak. Keep executing your system as normal. Don't change anything. Don't go changing things about your strategy just because you encountered some losing trades. Losing trades are the cost of doing business as a trader. And so long as they don't get out of hand and you don't risk too much per trade and you keep your metrics within the bounds of what is profitable based on your backtesting results, then you'll be fine. This is our job as traders. We devise a plan, we execute the plan, we analyze our results, and then we improve the plan, but only when necessary. Do that long enough, and it's simply a matter of time before you start making consistent returns as a trader. That brings me to the end of this episode. If you want to learn more about my style of trading, or you want to learn how to improve your trading based on some of the tools and techniques that I've learned over the years, check out my website at theartoftrading.com. There'll be a link in the show notes. I have tons of free content out there for you to go over, where I share the insights and breakthroughs I've had as a trader in my own journey, so that I can hopefully help you with yours. Take care, best of luck with your trading, and I'll speak with you in the next episode. Welcome to the Art of Trading podcast, the #1 podcast focused on trading psychology and performance, at least according to me. My name is Matthew and I'll be your host for today. Let's get started. Good news, traders. You can ignore the news. Many Forex traders and traders in general want to know how to trade the news. In their quest to master trading the news, they typically make the mistake of blindly trusting or even simply giving weight to what financial journalists and analysts say on television or the internet. This is a catastrophic error. I like to refer to financial news as financial entertainment. It makes a lot more sense if you think of it that way. Television and news outlets are not driven by the facts or even the truth, and they certainly don't have any incentive to make you money. They are driven purely by viewership. If they don't get views, they can't sell ads. And if they can't sell ads, they can't pay staff. If they can't pay staff, they go out of business. So they have every incentive to attract viewers by any means necessary, and very little incentive to make wholesome content or even accurate content. And what, above all else, attracts viewership? Controversy. It's the people magnet. We love controversy. It's a natural human trait. We all secretly enjoy a little bit of chaos in our lives. It's the real reason why Adam ate the apple. He blamed his wife and a talking snake, but really he was just bored and wanted some mischief in his life. Traders are afflicted by the same Achilles heel. In fact, in my experience, most traders are even more attracted to controversy than your average person, especially crypto and Tesla traders. Why is that? I think it's because traders are risk takers. We like a little bit of danger in our lives, or at least we welcome it without fear. This attraction to risk and acceptance of danger means we find mystery and chaos interesting. This makes us perfect targets for ambiguous, unhelpful, emotion-triggering financial news pieces designed not to enlighten us about the markets, but instead to make us feel anger, euphoria, confirmation bias, or a deadly combination of all three. These emotions lead to content engagement, which leads to ad revenue for these news firms. There's a fantastic book on this subject written by Ryan Holiday called Trust Me, I'm Lying, where he explains the motivations and incentives behind news and media companies. I'll leave a short video summarizing the book's message in the show notes if you're interested. Market analysts are performers. Financial news pieces are not made with your interests in mind. They are made with the single-minded goal of stimulating engagement by saying things that will cause traders to react in one way or another. Which way these traders react doesn't matter, so long as the news outlets get their ad revenue. In the blog post that I've based this episode on, I have a screenshot of the morning news that I was reading on my phone one morning before the trading session started for the day. The first article from Investopedia says, 2 recession indicators warn of danger amid bull rally. And then the next article directly below that first article from Australian Financial Review, AFR.com, the title of that news piece says, ASX poised to edge higher, and then the subtext says, the Oxford Economics Calibrated Recession Index indicates the odds of recession over the next 3 months are negligible. When the first article said 2 recession indicators warn of danger. This is an example of conflicting news pieces, and you'll see it everywhere in the markets. Now, this is all fine to participate in if you recognize that it's only entertainment and you have enough self-control to not let it influence your trading decisions directly. But if you are undisciplined or you don't have a strict trading methodology, then you will be susceptible to influence from or maybe even dependency on professional analysts, quote unquote. And they are not who you should be paying attention to. There is no such thing as a market expert. especially not in the world of financial journalism. After all, if they were so good at analyzing the market's direction, then why aren't they trading on their information instead of working for a wage at a safe and secure job with no skin in the game? Financial journalists are a lot like sports commentators. They're great for keeping track of what's going on in the game, but they won't help you to become a professional athlete. Your guess is as good as theirs. When you first begin trading, it's natural to seek some form of external respected authority to guide your decisions and inspire trading ideas. If you're lucky, this form of authority will be a mentor or a talented trading educator. If you are unlucky, this form of authority will come from society's built-in habitual dependency on traditional media sources, or social media, which is arguably worse. In our normal day-to-day lives, news serves a very important purpose. We rely on news pieces to keep us in the loop about what's going on in the outside world so that we can orient ourselves properly. The problem with financial news is that it's almost completely useless for traders. It's all speculative and colored by subjectivity. It's as reliable as a weather report. Sure, they might be right, but what if they're wrong? If you don't have a plan you can depend on when things don't work out exactly as the experts say they will, then you're screwed when they get it wrong, which is often. And if you do have a plan that you can depend on, then you especially don't need to pay attention to financial experts or financial analysts. They will only confuse you and hold you back. In most cases, if you have educated yourself about the markets you trade and how to read price action effectively, then you have about as good a chance of being correct as the experts do anyway. Now, I'm speaking directly to technical analysis traders here. If you're a fundamental trader, maybe you do need to pay attention to what's going on in the news for sentiment purposes. But I'm sure you'll still agree with me. The analysts know no better than you do about where a stock price or a market is headed. So news sources can be valuable for contrarian traders who like to trade against crowd sentiment. But for most traders and speculators, and especially day traders, it is completely useless information. Unless it's a catalyst for movement in price action and you know how to trade that movement, getting your directional bias from a news piece alone is futile at best and completely dangerous at worst. If you rely on financial journalists and experts to make your trading decisions, then you are going to seriously struggle to ever make any money in the markets. As of writing this blog post, I have a chart here of recent bullish Bitcoin price predictions at the time that I wrote this article. The price at the time of writing this article of Bitcoin was $5,500. The lowest prediction on the list of 9 different highly respected public figures involved in the financial industry was $20,000 by the end of 2018. The highest was 1 million. Now, 5,500 a full year after that prediction is not a good outcome. The reality is that even the most educated analysts in the media, especially technical analysts, have about as good a chance at being right in their calls as you do, and even less of a chance of being able to execute on it profitably, or else they would be traders. So why not take complete responsibility for your own decisions as a trader and remove the inefficient middleman altogether? At least you can develop consistency and a process to depend on and improve over time to suit your own personality, market perceptions, and risk tolerance. Never blindly trust anyone on a salary to tell you what to do with your money. They don't have any incentive to prioritize your interests over theirs. Okay, maybe you should listen to your accountant, but beyond that, you're better off educating yourself about financial markets and investing and trading than depending on some third party or some other person to make the decisions for you. Educate yourself well enough to make your own financial decisions or face the inevitable negative consequences of following others. A side note to this subject is economic data. When you first begin trading, especially in Forex, it can be tempting to try to trade these data releases as they come out because of the extreme volatility they can sometimes cause. But unless you are a genius at fundamental analysis, then I would advise against that. From personal experience, I can say that it is not as simple as it might look. First of all, if you guess the data release's outcome correctly, or you wait until you see the number before you take a position, the market reaction may be completely opposite to what you expect, as you have no idea what was already priced in by those traders and large firms that do trade based on fundamentals. And second of all, on that note, you are competing with state-of-the-art algorithms and scalp traders who have better information and technology than you, much faster execution times and better spreads. It is important to remember that market prices discount future expectations. They do not necessarily reflect the current valuation, but rather the near-term anticipated valuation according to known factors. If something happens to change the future outlook of a market, then you can see dramatic moves in the opposite direction to what you might anticipate from news or data that seems obviously bullish or bearish on the surface. This can especially occur when some pivotal piece of economic data comes out better than expected, but an unexpected caveat spooks the market. Here's a quote from Jack Schwager, the author of Market Wizards. This is an insight he gained from interviewing highly successful fundamental traders. A counter to anticipated response to market news may be more meaningful than the news item itself. This sort of thing happens all the time with releases like US job data, for example. I recall one time when I was new to trading and I was trying to make sense of non-farm payroll data. One day the data release revealed a huge increase in job numbers, and my natural instinct was that it was bullish for the US dollar, as I figured that was a good thing for the American economy. But smarter traders than me noticed that even though the jobs number increased dramatically and exceeded expectations, that might mean the economy is approaching peak employment and that the good times are nearing a cool-off period, which is a euphemism for recession. And worse than that, the average wages declined much worse than expected, which is bad for consumer spending, which is bad for economic growth, which might cause the Fed to slow interest rate hikes in the months to come, which is bearish for the US dollar long term, which caused the US dollar to tank dramatically for several days, much to my naive and expensive surprise. This is just one example of many. When you're dealing with economic data and trading based on news releases, you are playing a game of game theory. You're not trading the result that came out. You are trading the market's reaction to what the market expected the reaction to be. You need to think 3 or 4 steps ahead and thoroughly understand the data to gain a genuine edge out of that style of trading. Now, if you are talented enough to game theorize an edge out of this kind of activity in the heat of the moment with risk on the line and precise timing of the utmost importance while spreads are going haywire, then go for it. That's awesome. I wish I could do that. But most of us aren't good at this style of high-intensity cerebral trading, so it's best that we simply don't participate during these events and wait for the excitement to blow over and then ride the winds once a direction is confirmed. Leave the action to the algorithms and trading firms and all of those rookie traders who think they know what's going on. Protect your capital and then take advantage of the opportunities that are obvious. When it comes to economic data releases, I prefer to be involved in the trade well before the data comes out, due to technical reasons. If my strategy happens to put me into a trade before data comes out and my stop loss is in a favorable position, and then the data comes out in my favor, well, yippee, lucky for me. If it doesn't, then no harm done. More often than not, if an economy is doing well or poorly and price is trending, then the data tends to come out backing the trend anyway. But whatever happens or whatever I think might happen, I never outright bet on the outcome leading up to a data release. For retail traders, that is a fool's game. Price action is king. Obviously, this is not a hard rule. Some news events can offer great opportunities to trade if you have a strategy around it. Some news events can offer advance warning of potential erratic moves and spread spikes, which is useful to know from a defensive standpoint. And sometimes a news event can have a purely unidirectional impact on price, which can be taken advantage of. An example of this was the trade dispute between China and America a few years ago. Whenever the trade discussions hinted that they might resolve the issues, the markets moved higher. Whenever the tensions escalated, the market stalled or moved lower. It was a pretty obvious correlation and definitely tradable. But traders who trade this type of catalyst have a game plan for doing so. They don't buy a bunch of S&P 500 contracts simply because the president said the talks are going well. They have a detailed rules-based price action strategy around how they will respond to that news catalyst. They understand that price action is king. If you still want to trade the news despite its dangers, then make sure you use a strategy with edge and do it properly. Otherwise, stay away from it. Don't trust journalists and analysts. Don't gamble on economic data releases, and definitely don't do what Kramer says on Mad Money. Be objective and make your own decisions. How to trade the news if you still really want to. There is a single exception to all of this which falls outside of what I'm referring to in the rest of this episode, and that is catalysts. Trading news-based catalysts is very different to trading based on tips from journalists and analysts. If you are a trader who enjoys trading news catalysts, then that's fine, so long as you develop a consistent methodology around it that has a proven edge, and you're not just trading by the seat of your pants. When it comes to my personal niche of Forex trading, it's extremely difficult to trade news catalysts profitably due to a variety of factors. But if you are a stock trader, Their news catalysts might be exactly the thing you need to express your edge. In a video from this blog post that I'll link in the show notes, Steve Spencer from S&B Capital, a famous Wall Street proprietary trading firm, breaks down how his elite prop traders approach news catalysts. You should watch the video and note the complexity of their game planning. They don't make trading decisions based solely on the news. Rather, they screen the stocks and markets they choose to trade based on news catalysts for that day, and then they use their skills of price action analysis to trade the resulting momentum. They don't approach it with a bias one way or the other. And they certainly aren't influenced by the analysts' or journalists' personal opinions on the matter. All they want to know is whether the news will make markets react. Once they know that a news event is going to make a stock move, they have plenty of technical tools at their disposal to generate profits, regardless of how that movement unfolds. They're basically just waiting for a meteor to hit the ocean and create large waves, and then they surf those waves in whichever directions they unfold. They don't try to guess where the wave's going to go or where it comes from. They react to the reaction of the market. Now, it's also worth noting that if you are planning to trade the news, these guys are your competition, and they don't mess around. You better be willing to put in the same level of work and preparation as they do if you want to exceed at trading high volatility news events. In conclusion, obviously everything in trading is subjective. I'm not saying that if you watch financial news, you won't make money as a trader. Many traders take financial news very seriously and do great in the markets. What I am saying is that you don't need to turn to financial news outlets if you don't want to, and that you shouldn't depend on market experts to make your trading decisions. You are more than capable of becoming skilled enough to make your own profitable trading decisions without anyone else's input. And in fact, you are much better off without it. For many traders, this should be a relief. The day I realized that I would be better off completely ignoring what was said on financial news channels was an ecstatic day for me. How anyone can watch those idiots on TV argue and debate over speculative numbers and conflicting opinions all day without going nuts is beyond me. Real traders are typically not interested in that futile circus ego show. Professional traders are humble and focused on the long-term game. They're calm under pressure and confident in their own ability to make decisions. Financial journalists and analysts are far from matching that description. So don't pay them too much attention. Be your own market analyst. If you enjoyed this episode, make sure to share it. Make sure to do all the stuff that they all tell you to do every time a podcast ends. Best of luck with your trading. Take care, and I'll speak with you in the next episode. Welcome to the Art of Trading podcast, the #1 podcast focused on trading psychology and performance, at least according to me. My name is Matthew, and I'll be your host for today. Let's get started. Hey traders, today's episode is going to be about my opinion on doing nothing in the markets. The title of the blog post that I'm reading here is called "It's Okay to Do Nothing." I've mentioned many times on my blog how trading is one of the most counterintuitive professions you will ever undertake. Oftentimes what is right seems wrong, and what is wrong seems right. Today I want to address one question that many new traders have, and that is, does taking more trades mean making more profit? The short answer is no. The long answer is it depends on how good your strategy is, how cooperative the current market conditions are for it, and how skilled you are at execution and trade management. But generally speaking, more exposure to risk does not always equate to more realized profit, and often it actually leads to the opposite result. One of the traits that stands out across most highly successful traders, in my observation, through reading countless books, listening to countless interviews, and learning from half a dozen experienced market wizards over the years, is that successful traders are highly selective in which trades they take. They aren't sitting there looking for a trade every minute of every day. They are like hunters or assassins. They wait patiently and calmly for all the necessary factors to align that signal to them that they have a high probability or a high reward trading opportunity at hand, preferably both. And when that opportunity eventually presents itself, they act without hesitation. But in the meantime, they sit on their hands and they do nothing, or at least they don't make any trades. When I say they do nothing, I mean they don't act in the markets. When there are no opportunities, it's a good time to backtest, to reflect on your trading, to analyze your trading results, and to plan and build for the future. Or as Steve Burns, a famous trader who is the author of the book Rich Trader, said in his book, "We make our money in not by doing something, but by doing the right things. Sometimes the right thing is doing nothing." There'll be a link to Steve's book Rich Trader in the show notes. It's a fantastic book. I definitely encourage you to go and read it if you haven't already. Sometimes traders don't trade. There is a fantastic quote from one of my favorite trading books, Reminiscences of a Stock Operator, by the famous Jesse Livermore. In that book, Jesse says, "Remember this, when you are doing nothing, those speculators who feel they must trade day in and day out are laying the foundation for your next venture. You will reap benefits from their mistakes." I actually have this quote pinned to my wall above my computer where I trade, because when I first began trading, overactivity, overtrading was a big problem of mine. And so I put this quote on my wall to remind me every day that there's nothing wrong with doing nothing. You don't always need to trade in order to consider yourself a trader. This statement by Jesse really struck a chord with me when I first read it. In regular civilian life, outside of trading, it is normal to expect a return proportionate to the amount of effort you put in. In most jobs and professions, more work means more money, or at least more production output. But in trading, this belief is dangerous, particularly for newer traders. When you first begin trading, it is likely and normal that you will be excited to trade. It's fun, novel, and the potential for random punishments and rewards is literally addictive, just like in gambling. The problem with this is that if you begin to focus on the excitement and attraction of trading action, just for the sake of being involved in the markets, then you open yourself up to fatal vulnerabilities in your trading approach. A huge part of trading is knowing what not to do. There are far more things that you shouldn't do in the markets than you should do. Forex markets, which are my specialty in trading, are open 24 hours a day for 5 days a week. This means that if you're a Forex trader, you have 7,200 minutes each week to make good or bad trading decisions. And if you're a crypto trader, you have an extra 2 days to make potential trading mistakes or take advantage of opportunities. But it can seem tempting to try to spend every one of those minutes looking for reasons to get into a trade. But the relieving fact of the matter is that doing that doesn't necessarily mean you'll make more money. When it comes to trading, less is often more. Another quote from the great Jesse Livermore. "There is the plain fool who does the wrong thing at all times everywhere. But there is the Wall Street fool who thinks he must trade all the time. No man can always have adequate reasons for buying or selling stocks daily." Being flat is a defensive position. Taking no trades is a trading decision too. It may not seem like it, but each time you don't take a trade, you don't put your capital at risk, which is a trading decision like any other. Obviously, it also means you can't make anything. There is no reward if there's no risk on the line. But as you'll learn over time, making money is not the only thing you need to focus on in order to be a successful trader. At the time of writing this blog post, when I began trading my new pullback strategy, it didn't take me long to realize that I had a terribly bad win rate on Mondays. And actually, this is true to this day. I have several strategies that do not perform well on Mondays here in Australia because the markets are slow. It's not until late Monday night that the US market participants begin acting in the markets and moving markets. My Monday win rate over a reasonable sample size at the time was less than 25% of winning trades, while the other days of the week were much closer to 50%. And once I stopped taking trades on Mondays, it didn't take long to notice the positive effect on my equity curve. Every time I don't take a trade on Monday, I don't put my capital at risk with a horribly bad chance of winning. This act of staying flat on Mondays is actually a defensive position. It ensures that I stay in optimal condition to take advantage of opportunities later in the week that have a higher yield. It allows me to start each week off with stronger footing. I don't waste my ammunition on setups that aren't worth shooting at. Ammunition is valuable, and in trading, it is money. Conserving your ammunition is a wise idea when you know that higher priority targets are always on their way. It's not lazy to do nothing in the markets. It's not counterproductive to sit on your hands when the market conditions call for it. In fact, it's one of the main reasons I managed to get out of my drawdown at the beginning of the year that I wrote this blog post. I didn't turn my results around by taking more trades. I turned them around by taking less trades and being extra selective in deciding when to participate in the markets. Here's a quote from the great Jack Schwager, author of The Market Wizards. For some traders, the discipline and patience to do nothing when the environment is unfavorable or opportunities are lacking is a crucial element in their success. Don't micromanage your positions. Another temptation trap that new traders often fall into is micromanaging their positions. They think that if they spend more time staring at the charts and moving their stop loss and targets around, they'll have an even greater edge over the market as a result of their responsiveness. They feel the need to babysit each moment of the trade's lifespan. At least I certainly did when I began trading. But again, the relieving truth is that this won't make you more money. In fact, it's likely that you'll burn yourself out emotionally by judging the meaning of each and every tick until you make a bad trading decision or exit the trade entirely. Trading is stressful enough as it is. There's enough pressure on us as it is. You don't need to add to the stress by trying to outsmart the markets at every turn. Let the trade play out. Unless you are a consistently profitable scalper, then you should know exactly where you're getting in, what your exit reason will be, and what your risk is before you enter the trade. Then once the trade is placed, all you need to do is get out of its way. Yet another great quote by Jesse Livermore. After spending many years in Wall Street and after making and losing millions of dollars, I want to tell you this. It never was my thinking that made the big money for me. It was always my sitting. Got that? My sitting tight. Conserve your mental capital. Trading is a draining game. It will sap you of your energy both physically and emotionally. This is normal and it can be managed. But if you spend too much time obsessing over each and every tick in the market, then your trading results will suffer. Most traders, even professional day traders, spend most of their time waiting for factors to align. Trading is nowhere near as exciting as they make it seem on TV and movies. Like most other professions, it's a grind. There's a lot of boredom involved, but that's what it's like to be an elite trader. That's not to say that you should bum around and literally do nothing between trades. You should use that downtime to work on your trading process, work on your journal, do some backtesting, analyze your recent trades, look for patterns in your trading that could result in optimization of your edge. But when the markets are open and your charts are loaded up and connected to your broker, make sure to keep yourself in check. Remind yourself constantly what your job is as a trader. Wait only for occurrences of your edge and ignore everything else. Sit on your hands in the meantime. There's no shame in doing nothing. In fact, that's exactly what is required in order to keep yourself in optimal shape to take the most advantage of your best opportunities. Conserve both your financial and your mental capital. If you don't know what to do, or your trading plan says to wait, then don't do anything. It's okay to do nothing. It's better to do nothing than to do what is wrong. But whatever you do to yourself. Said Buddha. That's the end of this episode. I hope you found it interesting and helpful in your trading journey. If you want to learn more about what I do, my style of trading, some of the tools and techniques I employ to exploit my edge over the markets, go to theartoftrading.com. Thank you for listening. Best of luck with your trading, and I'll speak with you in the next episode. Take care. Hey traders, in this episode we are going to be breaking down 21 lessons that I've taken from Jesse Livermore. The title of this article is From Dirt to Riches to Suicide. Welcome to the Art of Trading podcast, the #1 podcast focused on trading psychology and performance, at least according to me. My name is Matthew and I'll be your host for today. Let's get started. First of all, who was Jesse Livermore? Jesse Lauriston Livermore is one of my favorite trader case studies. His biography was loosely fictionalized in the famous 1923 book Reminiscences of a Stock Operator, under the author's name Edwin Lafever. I probably butchered that pronunciation, but I did my best. There'll be a link in the show notes to the book Reminiscences of a Stock Operator. If you haven't read it yet, you definitely need to. It's a trading classic. Born in 1877 in Massachusetts to a poor family, he started his trading career as a teenager in an effort to escape a life of farming with his father. Dreaming of someday climbing out of poverty, he found work at a Boston stockbroker office, transferring prices from ticker tape to the quotation board. He placed his first trade in 1891 in Burlington stock, in a local bucket shop frequented by gamblers and suckers, and he made a profit of $3.12. Several years later, he was regarded as one of the most powerful men on Wall Street. After his first humble win, he continued to master bucket shop trading and earned the nickname the Boy Plunger because he was young and reckless with his capital. Yet somehow, due to his uncanny ability to read market patterns, he always seemed to come out ahead. By 1929, he was famous among the American stock market elite. They redubbed him the Great Bear of Wall Street after he profited over $100 million during a giant market crash, which is approximately $1 billion relative to today's money. It is said that JP Morgan himself personally contacted Jesse and requested that he temporarily refrain from short-selling stocks as he was crippling the American stock market. Jesse graciously agreed and then made another small fortune riding the rebound. But his success was not without setbacks. Jesse blew his account to zero several times during his career, declaring bankruptcy 3 times before his trading errors culminated in one final catastrophe that resulted in his suicide. In the article, there's a photo of Jesse with his wife. The photo was put in a newspaper article after his death, and the caption reads, "On November 27th, 1940, Jesse Livermore and his wife, Harriet, went to New York's Stork Club, where a photographer asked permission to take a picture. It's the last picture you'll take of me. Tomorrow I'm going away for a long, long time," Livermore said. His story is fascinating, and the book Reminiscences of a Stock Operator is one of the most memorable books I've ever read. I've been thinking about it a lot and why he killed himself, and I like to think it's because he was a trading pioneer who was mapping the territory as he went, like any great explorer. As the quote goes, "You can recognize a pioneer by the arrows in his back." Jesse didn't understand trading psychology, risk management, and emotional discipline as well as we do now as modern traders. The sad irony is that we, as modern traders, only know about all those important mental health pillars of successful trading because of traders like Jesse Livermore, who blazed the way and died in the process. It's easy to ask why did he do it, and be shocked that he repeated the same mistakes over and over and eventually literally capitulated. But I believe that's because it was the 1900s, long before the modern art and science of trading was formally established, and he simply didn't know any better. But thanks to him and the internet, we now do. And now here is a list of Jesse Livermore's trading rules and what I think they mean to us as traders today. Number 1, nothing new ever occurs in the business of speculating or investing in securities and commodities. Obviously, with technological advancements and the like, trading has changed over the past 100 years. But what Jesse is saying here is that buying and selling has existed for centuries. It's as natural to humans as speech. We are bartering creatures. We have always traded, speculated, gambled, and invested. And the underlying factors of trading, psychology, and edge, in other words, buying low to sell high, or vice versa, shorting a high price to cover at a lower price, and the emotional experience and reactions of traders has not changed fundamentally since the beginning of speculation. That's important to reflect on for any serious trader. Number 2, money cannot consistently be made trading every day or every week during the year. This rule emphasizes the importance of patience and selectivity. As I said in the previous episode, it's okay to do nothing, at least sometimes. Even elite traders who make money trading the markets on a daily basis have probably experienced occasional days of no high-quality opportunities. It's having the discipline to wait for your edge to manifest itself before you put risk on that determines your success as a trader. Number 3, don't trust your own opinion and back your judgment until the action of the market itself confirms your opinion. Price action is king. Don't trade off gut feelings. Don't listen to market analysts. Don't let any other traders influence your decisions. Unless, of course, they're a trading mentor guiding you as a beginning trader. But you should develop a trading plan, test it, then have the confidence and discipline to back it with as much faith as you can muster. Let the markets tell you what to do, not your fear and greed. Number 4, markets are never wrong. Opinions often are. You must take full responsibility for your trading results. There are no excuses. If you lost money, it's your fault. Price action is never wrong. Whether you were stop hunted, got caught in a gap move, got burned by a flash crash, got squeezed by market manipulators, or forgot to put your stop loss in, it's all your fault. If you accept that the markets are never wrong and that all of your results, both good and bad, are a product of your own decision making and trading plan, then and only then do you have the right attitude to succeed as a trader. Or as Victor Sperendio said, the trader who tries to blame his losses on external events will never learn from his mistakes. Number 5, the real money made in speculating has been in commitments showing in profit right from the start. It's unwise to hold on to losers, and timing plays a major role in the quality of trading opportunities. Many traders claim that their best trades started out profitable right away. They did not have to endure several hours or days or months of misery. They read the market conditions correctly, timed the market well, and optimized their position sizing as best they could. Keep this in mind when making trading decisions. This isn't to say you should immediately cut any trade that goes into the negative like a scalper might, but that you should be mindful of how long your setups take to play out and judge the health of price action accordingly. Number 6, as long as a stock is acting right and the market is right, do not be in a hurry to take profits. Or in other words, let your winners run. The trend is your friend. Until it ends, of course. This is a classic trading maxim for a reason. By keeping your losses small and letting your best winning trades play out to their full potential, or at least close to, then you can maximize your return versus your risk. Number 7, one should never permit speculative ventures to run into investments. What I think Jesse means by this is only trade the time frames you planned to trade. If you open a trade as a swing trading or intraday opportunity, then treat it like that. Don't get greedy and change your plan mid-trade just because you suddenly feel like you know better than the markets. Many traders fail to capture consistent profits out of the markets because they are inconsistent with their execution. Pick your trading and market portfolio and time frames wisely. Test them to confirm they have an edge, and then stick to them. Number 8, the money lost by speculation alone is small compared with the gigantic sums lost by so-called investors who have let their investments ride. I believe here Jesse is referring to the buy and hold strategy that many money managers and funds and value investors employ. While this is an effective strategy during bull markets, these portfolios are often slaughtered during crashes and bear markets. Here, Jesse is saying that if you manage your risk properly, the losses incurred by a good trader can be minuscule compared to a passive investor. Number 9, never buy a stock because it has had a big decline from its previous high. Or in other words, don't try to catch a falling knife. If an asset is falling rapidly at the height of a parabolic trend, it is probably doing so for a good reason. Think Bitcoin, the dot-com bubble, and any other bubble. There's a big difference between buying a dip or a pullback and stepping in front of a freight train. Sometimes buying into capitulation as a contrarian trading setup can work wonders under the right circumstances, but to the average trader, it is reckless and dangerous. Number 10, never sell a stock because it seems high priced. Never short against strong momentum, and don't be too quick to take profits just because you think your trade has exceeded its profit potential. Wait for a reason to sell or short based on your trading plan rules. A short period of extremely high valuations is not a good reason to sell in and of itself. In fact, that often marks the beginning of a parabolic move even higher. Number 11. I become a buyer as soon as the stock makes a new high on its movement after having had a normal reaction. I suspect here that Jesse is referring to buying breakouts into new highs in a trending market. Normal reaction is a bit subjective, and I have no idea what that meant to Jesse. I wonder if he even knew what that meant in black and white terms. Rules like this could have had something to do with his inconsistency as a trader over the long term. He made great fortunes, but also lost great fortunes over his career, probably because he didn't have clear rules around some of his techniques. But buying breakouts is an extremely effective strategy during bull markets. By buying late into strength instead of early into pullbacks, you are much more likely to make a profit than if you try to pick a bottom during the retracement. Number 12, never average losses. This is another classic trading maxim for a reason. Paul Tudor Jones himself had this phrase shamelessly pinned above his trading station during his rise to trading stardom. He had a sign on the wall behind his trading desk that said, "Losers average losers." Obviously, adding to losing positions was a disciplinary issue for him back then, and he believed it was important to eliminate it from his trading. And if he and Jesse think it's important, then you should too. When a trade goes against you, by definition, that means you are wrong about the trade. Either your directional bias is wrong or your timing is wrong. but that's why we use stop losses. Adding to a loss is the opposite of employing a stop loss, and it's no wonder it leads to many traders' demise. Number 13. The human side of every person is the greatest enemy of the average investor or speculator. This is a very insightful observation from Jesse given the times in which he lived. Trading psychology is the single most important pillar of any upcoming trader's process. Once you have made some sustained effort at developing a healthy trading psychology, it becomes less of a focus, but in your early days, there is nothing more important than this. If you want to be a successful trader, then you absolutely need to develop a strong psychology and healthy attitude towards trading. It's not optional. Traders must become their own psychologists in a way. You need to understand yourself inside and out, your emotional triggers and cognitive limitations, your strengths and weaknesses, your internal and external realities, and you need to account for them all with brutal objectivity and honesty. Number 14. Wishful thinking must be banished. There is no room for hope in trading. As Yoda says, do or do not. There is no try. So it is with trading. Once you develop your trading plan and your system, then your only job is to follow that system with as much discipline and confidence as you can realistically muster. If you find yourself wishing or hoping for something to happen, then chances are you are operating out of the wrong mentality. Either you've broken your rules, you're trading too big, or you haven't accounted for something in your trading plan that you need to. Number 15. Big movements take time to develop. Similar to rule number 6. Let your winners run. If you're trading a swing trading or trend following opportunity, then treat it as such. Be patient. Big price moves take time to unfold. And during that unfolding, it can be extremely tempting to interpret every tick as threatening, especially as profit grows. But be patient. Make sure you employ a robust trailing stop method that you feel comfortable with. Don't give up too much open profits, but don't suffocate your big winners either. Rule number 16. It is not good to be too curious about all the reasons behind price movements. This is a great one, perhaps my favorite on this entire list. We are curious creatures as human beings. We enjoy discovering reasons for things. We are obsessed with making sense of causality. That's a result of the fruits of several centuries of industrial, technological, and scientific revolution, which is obviously great. But in trading, it is better to leave certain things as a mystery. You don't need to know why price moves in order to exploit its movements. When I first began trading, I fell into the trap of researching every factor I could think of that might influence prices. It didn't take me very long to realize that there are so many influencing factors that it would be impossible to account for them all. That's why I now depend on one tool and one tool alone, which is technical analysis, or the study of patterns in price. Number 17. It is much easier to watch a few than many. This is another great tip. Limit your watch list and limit your portfolio of strategies. Unless through testing you have proven that diversifying your trades across multiple markets or assets increase the efficacy of your edge, then you should assume that it doesn't. Not only is there the edge of your strategy, there is also the edge of specializing in a market. If you know how a market typically moves because you've studied its activity for many months or years, then you will have an edge over traders who do not scrutinize that market as much as you do. A good example of this would be cryptocurrency. If you've never traded crypto before and you suddenly decide you think you have what it takes because you've had success trading stocks or Forex before, and you jump in fist swinging, you're probably going to get knocked out. Number 18. If you cannot make money out of the leading active issues, you are not going to make money out of the stock market as a whole. Leading active issues is old school jargon for leading actively traded stocks like Apple, Amazon, Netflix, Facebook, Google, etc. These stocks lead the market as a whole, and the indexes that track the market as a whole are heavily weighted by these market leaders. Here Jesse is saying that if the leading stocks are currently underperforming or in a bear market, then you are unlikely to make any money by investing in the overall market through an index fund or ETF or by trying to pick individual stocks to outperform those market leaders. This is why systematic traders like Nick Raj, for example, employ regime filters in most of their strategies. And a regime filter means if the S&P 500 is not trading above a key moving average, then his system does nothing. It goes to cash. Or in other words, unless the overall market is healthy, he doesn't try to buy individual stocks Because just as a rising tide lifts all boats, a falling tide pulls them all down. It's the same in the stock market. Number 19. The leaders of today may not be the leaders of 2 years from now. This is a wise observation that traders would be smart to consider. 2 years is a long time these days. Much longer than it was back when Jesse wrote these rules down. Thanks to technology, a lot can happen within 2 years. That means that you should not get too attached to positions in general, but you should also not count on the market leaders staying who they are forever. I know it's been much longer than 2 years, but who back in the early 2000s would have ever thought that someday companies like Apple and Amazon would be leading the entire stock market? Furthermore, the companies that currently lead the market face terrible odds of continuing success. According to a study by Mark J. Perry, which I'll link in the show notes, 88% of the companies included on the list of Fortune 500 companies in 1955 either don't exist today or have dropped off the list because they've lost market value. Number 20. Do not become completely bearish or bullish on the whole market because one stock in some particular group has plainly reversed its course from the general trend. This should go without saying in today's markets. It's pretty obvious that one stock does not dictate the direction of the entire market. There are a handful that might, but just because Apple is having a bad month doesn't mean that the entire Nasdaq is about to collapse, at least not necessarily. At the time of writing this article, Tesla was having a really bad month. And I said that just because Tesla is currently experiencing problems with its share price as of May 2019, does not mean that the entire electric car market is struggling. Shorting Ford or the entire Nasdaq just because Tesla is having a bad day is not a wise decision. Number 21. Few people ever make money on tips. Beware of inside information. If there was easy money lying around, no one would be forcing it into your pocket. This is great advice. All traders learn this at some point in their career, usually the hard way. Don't trust trading gurus and signal services, don't trust market analysts on mainstream media, and don't trust expert advisors and trading bots to make your money for you unless you created it yourself. No one is giving out free money. Don't confuse financial entertainment with financial advice. It can be very dangerous. That brings us to the end of Jesse Livermore's trading rules. Now I want to address Jesse Livermore's suicide. Here is the last note he left his wife, who he nicknamed Nina. My dear Nina, can't help it. Things have been bad with me. I am tired of fighting. Can't carry on any longer. This is the only way out. I am unworthy of your love. I am a failure. I am truly sorry, but this is the only way out for me. Love, Laurie. On November 28th, in 1940, Jesse shot himself in the cloakroom of the Sherry Netherland Hotel in Manhattan. Most trading blogs and articles tend to gloss over Jesse's suicide. I suppose it's a difficult topic to address, and one that doesn't exactly get readers excited about trading. I should also mention that his life was very complicated, including several failed marriages, a murdered son, 2 world wars, and God only knows what other problems he had that were never documented. So I don't want to suggest that any of us have a clue what was going through his mind at the time, or how related his suicide was to his trading results. But I want to dig a little bit deeper into this part of his story because I think it's incredibly important to recognize that one of the greatest traders in history ended his career with a gun in his mouth. Practice gratitude. Perhaps the most important and obvious takeaway from Jesse's story is that life is precious and that you should never take your health and your good fortune for granted. When things are going well for you and your family and friends, cherish those moments. They are, unfortunately, too few and far between for most people. I injured myself about 7 years ago in my early 20s and have suffered chronic pain issues ever since, which has been extremely difficult to deal with. I never imagined it would happen to me, but it did. And my most painful regret is not taking the time to fully appreciate my good health when I had it. It's still something that bothers me to this day, over a decade later. None of us are safe from life, so be grateful for the times when things are going well. It will fortify your spirit for when the harder times inevitably surface. Respect risk every day, forever. The second takeaway for me is that no matter how skilled or successful you become as a trader, the risk of ruin is always present. Just like the seasoned soldier on the battlefield is fully conscious of the fact that any bullet could be his last, any trading day could be yours. You can never forget, even for a moment, how important your risk control is. You must forever guard against complacency. It can take decades to build up a net worth of immense proportions through trading and investing, and then a single bad day to lose it all. Don't let that happen to you. The boneyard of failed traders and investors who met their demise as a result of neglecting to respect risk even after many years in the business is deep and ever growing. Find meaningful pursuits. The third takeaway for me is that you shouldn't attribute your feelings of self-worth with your trading results or your trading account. You need to neutralize your ego as a trader, not just because it will help you make more money, but because it will protect you from depression and serious mental health risks. There are very real mental risks associated with trading, which may be something you've never considered, as I didn't until I began to experience them myself. We've all seen the disclaimers saying trading is risky and you could lose your capital, but no one mentions you could also lose your mind. If you have an addictive and/or impulsive personality, then you need to be extra careful with your trading. You must put in extra homework on yourself and your psychological well-being if you plan to be successful as a trader. Money has the potential to bring out both the best and the worst in people. It's an amplifier. If you're unhappy now, then having lots of money will not make you happy later. As Tony Duff can attest, if your work and your life doesn't bring you happiness, then money won't help. Tony Duff has a great book documenting his decline as a trader into drug addiction and depression. I'll leave a link to his book in the show notes. It's a great read if you haven't read it already. Anyway, it is important that you develop meaningful pursuits outside of trading. Remind yourself constantly why you put yourself through the challenges of trading. If you are only focused on making money, then the frequent times when you are struggling to make money will seem unbearable. And finally, don't be stubborn. The most troubling part of Jesse's story is that he prophesied his own demise several times throughout his writings, and yet he continued down the path of self-destruction anyway. I suppose many people suffer from this affliction. I myself can definitely relate to the feeling of knowing better, but doing it anyway, and then facing the inevitable consequences of my stupid behavior. But in Jesse's case, it truly is a mystery why he continued to repeat the mistakes that led to his suffering right up until the bitter end, given his thorough grasp on the craft of speculation, as evidenced in his writings. I guess the most important lesson of all that we can take from his troubled life as a trader is that it never pays to be stubborn. Here's a quote from Jesse Livermore. "The game of speculation is the most uniformly fascinating game in the world, but it is not a game for the stupid, the mentally lazy, the person of inferior emotional balance, or the get-rich-quick adventurer. They will die poor." If you're interested in finding out more about Jesse's life as a trader, then there are a bunch of resources and links in the show notes. Thanks for listening. If you like this episode, make sure to do all the podcast stuff, share it, like it, subscribe, and I'll speak with you in the next episode. Take care, good luck with your trading, and look after yourself. Why do traders really fail? Depending on your goals and motivations, trading is one of the most incredibly difficult endeavors you will ever undertake. If your goal is to have fun and feel a rush, then trading will of course be easy. You won't make any money, but like any gambling activity that produces excitement, you'll get what you want out of it. If, however, your goal as a trader is to make yourself financially independent and generate consistent profits over multiple years, then trading takes on an entirely different shape. Many people have discussed the topic of the high failure rate in trading. They all mention how traders risk too much, lack edge, get too emotional, cut their winners short, let their losers run, overtrade, don't wait for market conditions to align with their strategy, don't have discipline, don't exhibit consistency, or don't start with enough capital, etc. But these are all pretty obvious technical obstacles to trading success, and all of them can be overcome with enough time and effort. So I don't believe that they account for the true reason why so many traders fail. So in this episode, I want to discuss my theory on why most traders fail to find success, which includes the phenomenon of Price's Law and the Pareto principle. There's obviously a big difference between a hobbyist and a professional. Traders who treat trading as a hobby never really make any money. Maybe they get lucky here and there, but over time, it's basically akin to gambling. I've never met a trader who treats their trading casually like a hobby, who made a lot of money. That's because the main difference between a hobby and a career is that a hobby costs you money, whereas a career or profession generates income. Everyone wants to be a professional athlete or a famous actor or a great writer or a hilarious comedian or a rock star musician or a wildly successful businessman or a supermodel or a professional gamer or, in our case, a profitable trader. And everyone plays sports on the weekends or takes an acting class occasionally or writes short stories or cracks jokes at parties or plays guitar in a garage band like I did for many years, or works long hours at the office or looks good in makeup or kicks ass at video games or otherwise dreams big. So what is it exactly that separates those who attain the goal from those who simply want it? What is the difference between a naturally talented professional and a doomed to failure hobbyist? Let's find out. What does it take to be successful? There are many prerequisites to achieving success in anything. The first is that you need to be in a position to achieve success. You need to be healthy. The healthier, the better. You need enthusiasm and energy. You need genuine curiosity in the subject you're pursuing. You need to be disciplined. You need to be committed. You need to have perseverance. You need to have the right education and some degree of compatible natural talent. You also need a stable environment. If you live in a destabilized country or a wildly unstable home or family life, then pursuing entrepreneurial success of any kind will be impractical, if not completely suicidal. Then you also need the right social network and professional relationships, the right technology and resources at your disposal, the time and space to get the many things you need to do done. You get the idea. There are many multifaceted obstacles to success. There needs to be a lot of things going right for you before you can even set your sights on ambitious goals like becoming a millionaire or having financial independence, let alone achieve those goals. Only once you have all or most of these things in order can you begin the process of developing experience and skill in the markets. Only once your environment, circumstances, and personality are aligned with your goals can you properly begin the journey of becoming a professional trader. Many people do not meet these requirements, are unwilling to develop them, and are therefore doomed to failure right off the bat. That alone probably accounts for most failed traders right there. What is Price's law? Once you have all these prerequisites in place and you begin your journey towards trading success, or success in general in anything, there are a number of additional factors that come into play that affect the outcome of your efforts. I'll leave a link below to a lecture by Dr. Jordan Peterson. Now, he's a controversial character, I know. Not everyone out there agrees with all of his ideas. Even I don't agree with all of his ideas. He has quite a eclectic philosophy that ranges across many subjects. But in this lecture I'm talking about, I definitely encourage you to go and watch the short clip. It's only 10 minutes long or something. Jordan discusses the phenomenon of Price's law and the Pareto distribution in relation to people's ability to perform at high levels of creative or productive output, especially in terms of financial success. Now, I'm no expert on this subject, but I'll break down what I've learned and internalized from studying some of these concepts and watching a bunch of lectures on the subject. So Price's law was first penned by the physicist Derek J. DeSolla Price. During his career as an information scientist, he discovered that half of the scientific literature published at the time he was involved in his career came from the square root of the total number of contributors. So in other words, he found that if 100 papers were written by 25 authors, then 50 of the papers would have been written by just 5 of the authors. In simple terms, this means that a minority of contributors account for the majority of contributions. Jordan Peterson, in his own studies, has found evidence to suggest that this correlation between productive output and a small number of relative contributors applies to all areas of creative endeavor, not just in scientific literature. This means that in nearly all careers and vocations, a small number of people account for up to half of the productive output from those roles, which in theory translates to a small number of people being far more successful than the rest, not just in trading, but in all areas of life. Now, I'm not a religious person, but this concept was even mentioned in the Bible, which is a pretty ancient book, I think we can all agree, and is known as the Matthew Principle, which means this principle has been understood by human beings for centuries. In Matthew 13, verses 11 to 12, it's written, "For to him who has will more be given, and he will have abundance. But from him who has not, even what he has will be taken away." This, apparently, is a natural law, not an anomaly. So what is the Pareto principle? If Price's law dictates that a small minority of people account for the majority of productive output, then the Pareto principle dictates that a small minority of energy accounts for the vast majority of output in all areas of life. In the article I wrote that I'm reading here, I linked to another blog post by Dean Yong, who explores this subject in great detail. I'll leave a link in the show notes to this article. It's quite interesting. To paraphrase his words, Vilfredo Pareto, I probably butchered that, was an Italian engineer, sociologist, economist, political scientist, and philosopher. He's a busy guy. He made numerous important contributions to economics. One of the most profound contributions Pareto made is his study of income distribution. He discovered that each individual's income in a country follows a power law probability distribution from his observation that 80% of the land in Italy was owned by just 20% of the population. This pattern is named after him as the Pareto principle, also known as the 80-20 rule. Now, I'm not going to pretend to understand some of what I just said, but the core concept here is that 80% of most outcomes, particularly in productive aspects of human life, comes from 20% of either the energy that was put into that work or 20% of the people that were involved. Or in other words, the Pareto principle or 80-20 rule means that on average, 80% of our output is derived from 20% of our input. According to this principle, the majority of our productive outcomes, creative achievements, money earned, points gained in a computer game, progress made towards improving our skills, etc., comes from a minority of our efforts. This Pareto principle ties in almost perfectly with Price's law in that the two phenomena combined seem to explain why there is such a disparity between those who succeed at something complex or difficult and those who don't. Or as Jordan Peterson says during his lecture on the subject, instead of reading this, I'm going to play a clip from him from his lecture so you can hear how he explains it.
And so what you see, and this, what's happening is that to do really well at a given productive task, which would also include generating money as a proxy for creative productivity, is that you have to be, a bunch of things have to go your way simultaneously. So maybe you have to be really, really smart, you have to be really, really lucky, you have to be really healthy, you have to be really energetic, you have to be really conscientious, you have to be in the right time at the right place. And maybe you also have to have the right social network, right? Like, so it's a lot of things, and each of those are small probability. Each of those are small probabilities, and then if you multiply the small probabilities together, you get an extraordinarily tiny probability. And you have to have all those things functioning before you're going to end out on the extreme end of the productivity distribution. But if you do end up there, then you produce almost all of everything.
Again, there'll be a link to this lecture in the show notes. It's very interesting. The Pareto distribution is the effect of the Pareto principle and Price's law in play. If you were to plot all traders on a graph, the successful traders who make most of the money out of the markets would make up a very small portion of the graph relative to the majority of traders who try their hand at trading. We see this in many areas of life. We see it occur in celebrity phenomenon. We see this in the markets itself. Think of FANG stocks, Facebook, Apple, Netflix, Google, Amazon. There's a handful of companies that lead the market in terms of their market share, their profitability, even how much they make up of certain indexes. We also see this in trading. More than 90% of traders fail to make consistent money out of the markets. We see this in macroeconomics. 1% of people control a large portion of the world's wealth. And we see it even in creative achievement itself. The average person scores a total of 0 on the creative achievement questionnaire, which is an objective method that the psychologists and the people who study these sorts of things use to objectively grade people's creativity. The average person scores 0, meaning they're not creative at all, while a very small fraction of people score very highly across multiple domains. It's very interesting. We even see this in nature, almost everywhere. I'll leave a link in the show notes to a post on Quora that lists the various ways in which this phenomenon of the Pareto principle occurs in the natural world. One university student commented on the post, and this comment caught my eye. I thought it was quite interesting. I don't know if it's true, but it's an interesting concept to think about. They said, invest 20% of your time every day in doing something that fascinates you, whatever it is, let's say programming. One day, you will find out that you are above 80% of people in that particular field. Now, I don't know how you would objectively verify that, but it sounds about right to me. I believe this to be relatively accurate. Before I injured myself, and developed a repetitive strain injury in my arm, I got really good at playing guitar. I could perform almost anything from any genre of music by ear without needing to read any music. I didn't know how to read sheet music, but I got really, really good at guitar. Yet, when I first started playing guitar, I was totally clueless and hopeless at playing. I couldn't play anything without a real struggle. It took many years of dedication and daily practice to get to a point where I could play better than almost everyone I knew. Now, it was not because I had some kind of natural skill, although I was definitely naturally drawn to music, but rather it was because I put in the work that many others wouldn't be bothered to do. Whenever I got home from work or school, rather than hang out with my friends or play video games or do normal teenage stuff, most days I'd literally spend up to 4 hours playing guitar in my room to myself, which equates to 25% of a 16-hour day, which is the average time spent awake. It was honestly borderline insanity and likely a form of addiction, but it paid off massively over the years, in so much as I got really good at guitar. Until, of course, I injured myself and decided to become a trader instead of a musician. But I believe that this Pareto principle also applies to trading. It's not enough to simply want success. We all want success, even and especially those who fail. It's not enough to be able to read charts and price action and fundamentals. It's not enough to know what to do technically. Knowing what needs to be done and doing it exceptionally well are entirely different challenges altogether. Is your heart truly in it? There are many factors that influence the manifestation of Price's law as a phenomenon in human achievement, such as all the ones I mentioned at the beginning of this post relating to personality, health, environment, and luck. But there is a final and major factor that influences people's ability to achieve success in highly competitive arenas of productive output, or in our case as traders, a zero-sum game, and that is your heart. You might have the brains and mind and a compatible disposition to become a trader. It's my belief that almost anyone has the ability to become a successful trader, so long as they have decent competence with computers and relatively complex ideas, and good guidance. Just like I believe anyone can become a great guitarist if they have a passion for music and they put in the proper work and practice every day. But if you don't love trading, and you aren't willing to sacrifice significant amounts of your time and energy in order to truly master the skill, then unfortunately you are going to be trodden on by those traders who do love trading and who are willing to do the work. Trading is not for everyone. It's frustrating, it's slow, it's monotonous at times, it's lonely, it's misunderstood, it's competitive, it's brutal and unforgiving. But it's also highly rewarding for those who are willing to endure those challenges. So make sure you know where you stand long before you begin your journey as a trader. Make sure that you are in it for the right reasons. Not just the money, but because of a passion for trading and participating in markets. Because if you're not in trading for the right reasons, then whenever you lose money in the markets, you'll be losing it to those traders who are trading the right way and for the right reasons. What does this all mean? The Pareto distribution means that only a few can ever end up with the goods, while Price's law means that only a few have the ability to endure what it takes to achieve exceptional success, and the two go hand in hand. I agree with Jordan Peterson's belief that this occurs because of the immense improbability of each person having everything aligning for them on their path to success in any given complex or competitive endeavor. The odds of you simultaneously being healthy in the right environment with the right intellectual ability and the right emotional disposition, the right mentors and training, and a natural unforced passion and curiosity to excel at any given task are actually incredibly slight. In trading, this comes down to those who love trading, who are disciplined and patient, and have the necessary cognitive skills to win consistently. It's no accident or conspiracy that many traders fail, while there are a remaining few who become wildly successful despite the odds. As Warren Buffett says, the stock market is a device for transferring money from the impatient to the patient. This observation by Warren Buffett is 100% true, but it's also just the tip of the iceberg. The markets are also a device for transferring money from the undisciplined, the uncommitted, the unfocused, the underprepared, and the underperforming to those who have what it takes to maintain high levels of elite performance. Your success is not dependent merely on you having what it takes. There is much, much more that goes into your success as a trader. So really, it should be no surprise that so many traders fail. In fact, I would go so far as to say that exactly the right amount of traders fail. Trading is great in that it allows anyone to try it. There's no barrier to entry except having some money. Now, this wasn't always the case, but with modern technology, it is increasingly accessible to everyday people. But everyday people don't have what it takes to be traders. My cat wants to join. You happy, mate? You happy you barged into my office? Well done. It's figured out how to open doors. Where was I? Everyday people can access the markets, but everyday people don't have what it takes to be traders. Just like everyday people don't have what it takes to be an NBA star, or a racing car driver, or an astronaut. In today's society, we like to believe that equality is a right that everyone has. And while I believe that no human being is worth more than another,
and equality of opportunity is not the same as equality of outcome,
there are unfortunately limitations around our capabilities as individuals in certain arenas. So the bad news is, if you come into trading with an everyday person attitude and mentality, you will be steamrolled. The good news is, if you can break out of that mentality and develop sincere specialization and skill in trading, which requires genuine passion and commitment that can't be faked, then you stand a very good chance of success. There's plenty of money to go around in the markets, trillions of dollars. And if you develop the right skills and discipline to execute consistently and properly, then you'll make all the money you deserve to make. That's the beauty of trading and what makes all of the effort worthwhile. There is no cap on your pay other than the capital that you can trade. But you don't need to ask anyone for a raise. You don't need to negotiate with anyone to get what you've earned. You just need to put in the work on yourself and your process, be patient and realistic with your expectations, and as a result over time, you will significantly outperform and out-earn the thousands of traders who aren't capable of doing all that. How to achieve success despite the odds. Admittedly, some of this research is disconcerting. To a large degree, it means that natural laws govern how much we can and can't achieve. But we've always known this to be true, despite our reluctance to acknowledge it. We are all painfully aware of our own limitations. And it's no secret that life is often arbitrary and indiscriminate in how it dishes out rewards and punishments. Just because you want something badly and you're willing to sacrifice everything to get it, doesn't mean you are guaranteed to get what you want. There's still a chance that despite your best efforts, you won't get it. But the good news is, if you do everything in your power to set yourself up for success, and you commit to the long-term goal, and you are rational in your expectations and your efforts to achieve them, then the probability of you being successful skyrockets. This is because most people simply aren't willing to put in that much work to be as good as you are. By merely committing to becoming a successful trader and truly putting your heart and soul into performing your tasks to the best of your abilities, you effectively reserve your seat at the table of success. Or as Dean Young said, because of Price's law and the Pareto principle, every tiny improvement matters a ton in a relative environment. If you want to achieve success in spite of all the obstacles that you will inevitably face and pop out on the correct end of the Pareto distribution, then you need to align yourself totally with your aims. Set a meaningful goal that you find extremely valuable and motivating. Make it one that will motivate you to get out of bed every day and get going. It needs to be a goal that, if you were to achieve it, would make all the suffering in order to get there worthwhile. Also spend time reflecting on the things that would prevent you from achieving your goals. In the case of trading, maybe that's risking way too much on a single trade, or breaking your rules and taking a trade you shouldn't be in, or some other form of habitual self-sabotage. You need to reflect on these issues until it makes total obvious sense to you to not do that behavior. You need to dive really deep into the whys of your trading. As Nietzsche once said, he who has a why can bear almost any how. If you can't bring yourself to do all of this, then you will never make it past the many obstacles that present themselves. Your heart is simply not in it. If you can't do the work required to get better, and you are losing money trading, then it's possible that you aren't meant to be a trader. There are easier ways to make money, believe it or not. So if you came to trading as a get-rich-quick vehicle, then it would be wise to reconsider your plans. The markets eat people who want to get rich quick. In any case, you can't force your interests. You must choose ones that are not only within your realm of competence, but also ones that spark a natural curiosity in you. This is the hardest part of all, because it can't be taught or manifested by willpower alone. It requires reflection and deep thought, and a lot of external influences that could be described as fate. If it's your fate to be a trader, then you will know pretty quickly. For me, I knew I was destined to be a trader when I blew my first account. Ironically, this experience sparked a drive in me that I couldn't extinguish. My first taste of failure was what motivated me to commit to success. When I blew my first account, my first thought was not to blame the markets or even to beat myself up too bad. I just had this overwhelming feeling inside of me that even though I had just failed as a trader in the most literal manner possible, I could have done much better if I'd known more about what I was doing. My head filled with reasons why it happened to me and how I could avoid it happening again. So, when I blew my second account and felt that feeling even stronger, I knew for certain that this was for me. I was going to become a trader, and thankfully, I haven't blown an account since then. I've actually done quite well over the years. But when you can trade every day for 12 months straight, getting your ass kicked, losing all your money twice, and then come back for more, not because you enjoyed the excitement or you want a revenge trade, but because you genuinely want to get better at the game, then that's when you know you found a game that truly interests you. Now, I'm not suggesting that you go out and trade recklessly for a year and blow a few accounts in order to discover whether or not you truly love trading. But I'm sure there have been occasions where you messed up during your learning process and you had the opportunity to quit, give up, or simply fail to learn anything. If you turned that difficult moment into an opportunity to improve yourself and get better at the game of trading, then, if you ask me, you've already passed the test. You are destined to be a trader. That spirit alone sets you apart from 90% of other traders. And it may be that spirit alone that makes all the difference between successful traders and unsuccessful traders. At least that's my belief. If you have the right spirit and attitude, then all that's left to do is account for your weaknesses, develop micro routines and habits that set you up on the path for success, and generate positive feedback loops wherever you can. Take the minor details just as seriously as the major details. And don't just compound your capital, compound your wealth of knowledge and skills too. I'll end this episode with a final quote from Jordan Peterson.
So even, because I mentioned to you, for example, that number of basketball hoops successfully managed by NBA players is Pareto distributed. But that's also, those are measurable with money, because of course you get paid to do it, and it is a social game. And so maybe it is an inevitable consequence of trading in a social game that you produce Pareto outcomes. And then I was trying to figure out why. And I've always had this suspicion that what happens to people is that as they move towards zero, positive feedback loops get set up so they're more likely to hit zero. And as they move away from zero, positive feedback loops get set up so that they're increasingly more likely to move away from zero.
Never fall to zero. Good luck with your trading. I'll speak with you in the next episode. Make sure to subscribe. Go to theartoftrading.com for links to all of my social media, Instagram, YouTube, my courses on how to create your own scripts to help with your trading. I don't teach people how to trade yet because I'm just not in a position where I feel comfortable doing that. But I do help traders who already have a trading methodology code their techniques into scripts so that they can objectively define their trading process and create tools to assist with it. So if that sounds interesting to you, go to pinescriptmastery.com or theartoftrading.com. Have a great day. I'll speak with you soon. Thanks for listening. There are many common themes and threads among the world's most successful traders. The self-discipline and self-awareness to first conquer the markets and themselves, and then to manage massive amounts of money without succumbing to regular human weaknesses, vices, and psychological perils that typically affect people. They also have the self-confidence and openness to take risk, not just financially in trading, but in betting on themselves as entrepreneurs and independent market combatants. And they all have the humility to accept losses and know when they are wrong, and the endurance to take the pain of not only losing money, but also failing to make a correct call repeatedly. While all properly initiated traders know that being frequently incorrect in your opinion and taking regular small losses is irrelevant to good trading, it is a form of Chinese water torture for the vast majority of people, and downright unacceptable in most occupations. That makes these character traits